Right, good morning to our wonderful audience, and thank you once again for joining us for our Offshore Manager webinar today. Really great to see so many of you on the call, and thank you again for your continued support. We remain ever grateful. We have a fantastic lineup for you today of 10 leading investment minds, mainly looking at global equity while taking a deeper dive into developed market equity, emerging markets, as well as global fixed income. The session today will be very fast-paced, but we will have time for one or two questions. So you're more than welcome to post your questions in the chat box or the Q&A box. Send it through to us while the presenter is going, and we'll try to cover those questions as best we can, time allowing. It's been an insightful year for 2023, so many moving parts and many levers to pull. A lot of questions around portfolio construction, especially when it comes to global equity. And if you look at things like our currency relative to the US dollar, and those are some of the things that we will definitely unpack during the course of this session today. Dislocations in sector and regional performance are ever increasing, especially if you look at the AI sector or tech stocks, how far it's pulled apart from other type of equities. And yes, inflation are moving lower, but US bond yields are still on the rise. I think the highest has been since 2007. This also sparked a lot of jitters in the markets the past few weeks, hence the weaker performance in August. The US economy is still sprinting on the back of fiscal stimulus from the Biden administration, fighting the Fed on the other end. Will this continue, or can this continue into an election year? How much room is there still for the US or politicians to maneuver? US equities relative to bond markets appears to be super expensive, and one should question the reward from equities, not even to mention valuations of the Magnificent Seven, as mentioned earlier. China again unlocking, a lot of anticipation beginning of the year and how it can prop up global growth, especially in that of emerging markets. But that dissipated very quickly and tends to be disappointing. And if you look at numbers coming out of China, probably the worst performing sector or region for the first half of 2023, a little bit different for places like India. What can we realistically expect from markets in a rapidly changing world? This brings me to our guest speaker of the day, all the way from Montreal, Canada, Chen Zhao, the founder and chief global strategist at Alpine Macro, one of the top global independent research firms in the world. Chen is renowned as one of the top global macro strategists, and prior to Alpine Macro, he was co-director at Brandywine and chief macro strategist at the BCI. Chen, it's really great to have you with us this morning. I believe very early your side. So we are grateful for you joining us. And we're really looking forward to your views on what the world looks like from your perspective.
Thank you, Eugene. Good morning. I hope it's a good morning. Definitely a good morning for me. I'm 5:30 here in the morning in Montreal. I will probably spend about 20 minutes or so to go through my story. And then I believe that there'll be a question and answer session after that. But anyway,
Yes.
Up to you guys whether we're going to do that or how we do that. But anyway, let me go through my story first. I don't know how familiar you guys are with Alpine Macro, but we took a pretty bullish stance on the US equity market pretty much since September 2022 all the way to mid-July this year, when we tuned down our bullishness on US equities. The reason for that, of course, there's a multi-factor reasons why we took down our bullishness, because throughout September 2022 all the way to July, we were bullish and we were comfortable because most of the strategists and investors was pretty bearish. At the time, the dominant narrative was that the U.S. was inevitably going into a recession, and we were very few that actually out there that are against that view. The problem today is everybody has been swinging towards the same direction. Being bullish is no longer, is right at the center of the global consensus. Of course, that is not the only reason that we tune down our bullishness. There are a couple of reasons. One of the main reason actually is this. I think if you read today's reports from around the world, everybody was talking about soft landing, perfect landing, no landing, immaculate disinflation. There's all these beautiful words to describe what's going on in the U.S. economy without actually explaining what the hell is going on, why the U.S. economy has demonstrated such a resilience against the background of one of the most aggressive monetary tightening. Nobody actually gave me a convincing reason. I'm just asking myself. The only reason that people become bullish is because stock prices have gone up, so everybody has to be bullish. That bothers me a lot. So that's why today I'm trying to present you with some of the reasons that explains why the U.S. economy has been doing what it has been doing. In other words, why the U.S. economy has shown such an enormous amount of resilience, despite the fact that the Fed policy is very tight. Let me go through a few charts. You know exactly what I'm talking about. If you look at the chart here, on your left-hand side.
Shin,
yes?
Sorry to interrupt you. We can't see your slides yet. If you can maybe just try to share them again.
Sorry, I'll probably...
No problem. Yes, coming through. We can see them.
Good.
Perfect. There we go.
Okay. If you look at the chart here on your left-hand side, that's what I just said. This is one of the most aggressive monetary tightening. If you look at the chart here, the red dotted line actually is the Fed policy rate, and the blue line is monetary aggregate. So today, if you judge by the speed of increase in interest rates, this is probably the most aggressive monetary tightening of all time, because if you judge by the speed of increase in interest rates, we're talking about from 0 all the way to 5 in 18 months. That is really fast. But also this monetary tightening is combined with monetary contraction. You can see the M2, the blue line here is going down, actually it's contracting. That has never happened in the US history. So despite of this very, very aggressive monetary tightening, then if you look at the economic response, that is quite enormous, actually. If you look at the chart here on your right-hand side, let me explain what this is. If you look at the top panel there on your right-hand side, the top panel is EPS for S&P 500. Basically, think about that as a profits. You can see that in the past, the profit cycle usually do not turn up until the Fed is well into monetary easing cycle. You can see that in the past. Basically, every time that the Fed start to cut rates and actually start into a rate easing cycle before the profit cycle start to bottom up. But this time around, you can see the Fed fund rate is still very high, and we're not even sure whether the Fed is tightening or not. And you can see that the anticipation is that profit growth is going to re-accelerate. So this never happens in the U.S. history. You can see that. And then if you look at the chart here on your left-hand side, same story. What is this? If you look at the top panel here, the top panel is detrended Fed fund rates. Why do I use detrended Fed fund rate? It's just simply to get rid of all this big declining trend over the years, so that you can see the fluctuation better. You can see that Fed fund rates every time the Fed tightens monetary policy. What happens? What happens is that if you look at the bottom panel, that is the PE ratio for S&P 500. So every time the Fed tightens monetary policy, there was always a period of PE ratio contraction. So this time around, you can see that, yes, the multiples came down very briefly, and now it is expanding again. Again, we're not even sure the Fed has done the tightening or not. You can see that that is quite unusual policy, quite unusual market response to the tightening. So I can go on and on, but the bottom line here is that the market response and economic response to this tightening cycle is very, very unusual. It's completely outside our past, outside the boundary of our past experience. That's why I think I'm bothered by the fact that everybody's sort of starting to turn bullish without understanding why policies, why monetary policy has not really produced any desired result, and yet everybody is turning bullish. Now, let me explain why the economy has been doing so well in spite of the fact that the Fed is really trying to cool it off. I think there are three broad reasons that explaining the underlying strength of the U.S. economy. The reason number one, of course, is this chart. If you look at the chart here, on your left-hand side, let me explain what this is. If you start from the bottom panel here is the primary budget balance. Here, it is important to keep in mind we're using primary budget balance because primary budget balance basically take out the interest payment for the current debt load, because the interest payment doesn't do anything to the economy, it doesn't add any aggregate demand. So that's why when you look at the net impact of fiscal policy on the economy, you usually look at the primary budget balance. You can see here on the bottom panel here, the story here is if you look at the primary budget balance, it started to grow again, third quarter of last year, meaning the fiscal contraction actually ended pretty much at the third and fourth quarter of last year, and is replaced by renewed fiscal expansion. This is very important because this is quite unusual, because if you look at the U.S. post-war history, monetary policy and fiscal policy most of the time work in the same direction, meaning fiscal policy usually is very counter-cyclical, but this is the first time that fiscal policy becomes very pro-cyclical and working against the Fed policy. So the Fed policy is tightening on one hand, the fiscal side that actually is stimulating on the other side. So this is very extraordinary. In order to just look at how big the fiscal thrust to the economy, we break down to the quarterly series. If you look at the chart here on your right hand side, this is the fiscal thrust over GDP ratio. What is fiscal thrust? I just want to be a little bit careful here. Fiscal thrust is basically net change of primary deficit, because the deficit itself doesn't tell you how much the deficit actually is producing. The deficit is producing growth, but only thrust actually give you the measurement of how fiscal policy is impacting the economy. You can see here on the right hand side, the fiscal thrust as a share of GDP is about 6%. That is a very big number. I'll just give you a little bit of perspective. If you look at 2001, when the tech bubble burst and the U.S. economy was in mild recession, fiscal thrust is about 6%. In other words, since third quarter last year, U.S. fiscal policy is adding stimulus pretty similar to the amount that you usually see during the sort of a garden variety recessions. So that is a very significant amount of growth support from the policy, from the fiscal side. When I wrote about this about 2 months ago, very few people noticed about it. Very few people talked about it. I'm just thinking to myself, I mean, I just want to make sure that I'm not talking something stupid, because how come nobody picked that up? Maybe there's a cyclical, maybe the cyclical adjustment have taken place that basically explain people are not really talking about. But anyway, I just want to make sure that I'm talking about something that is correct. That's why I look a little bit deeper into the picture. Here is the picture here. I mean, if you look at the chart here on the left hand side, this is a spending versus receipts. So it's pretty clear that actually the stimulus come from both fronts. not only spending, which is spending net of interest payments, has been going up almost $1 trillion, but the receipt, the tax revenue actually coming off about $400 billion since pretty much third quarter 2022. We understand what happens in the receipt side because the capital gains tax 2022 was pretty lousy. Nobody made money. That's why the capital gain tax collection basically came down very hard. That explained that $400 billion of short in the receipt side. But the spending here is the driving force. The spending has gone up quite considerably. I think that has everything to do with the 3 spending packages that passed before April this year, when Democrats control both the Congress and the Senate. The 3 packages include the Infrastructure Investment Act, CHIP Act, and Inflation Reduction Act. So all these 3 packages actually add up to a lot of lots of spending. And right now, I can see that since third quarter last year, these packages are being implemented over time. And that actually explains why the spending increase is being very, very sharp. Just to give you a sense of how sharp the spending increase has been, if you look at the chart here on your right-hand side, this is the annual rate of growth for the net spending. I keep emphasizing net spending. Net spending basically, again, is a spending net of interest payment. As you can see here, the net increase is about 16% per annum. That, again, is very similar to the size of spending increase in 2001 when the U.S. economy was in the tech bubble-induced recession. So in other words, this is a big amount, big number that actually has been explaining, partially at least, why the U.S. economy has been so resilient. So that's reason number 1. Reason number 2, why the U.S. economy has been so resilient is this chart here. If you look at the chart here on your left-hand side, you can see that U.S. labor productivity completely collapsed during 2021, when every company in the U.S. went out and overhired a lot of people. When the U.S. economy was just reopened. At the time, the output growth was not there. That's why you had a productivity decline that actually set the record. If you look at the U.S. history, minus 2.5% productivity gain, that is absolutely all-time low. You never find any period that is lower than this. So we also understand one thing, which is labor productivity growth is always mean reverting. If you look at the U.S. history, especially recent history, U.S. labor productivity growth is always 1.5%. So we know for sure if the productivity growth collapse to all-time lows, the natural tendency is for this theory to go back to the mean. Actually, that mean reverting process actually took place pretty much since third quarter of last year. You can see here the swing is about 3 points. Now, why this thing is important? I just want to remind people a little economics that we learned from school. GDP growth for any country, I don't care whether it's South Africa or United States or China, GDP growth basically equals to 2 things: labor force growth plus labor productivity growth. That's one way to calculate GDP growth. That's what I'm saying. This big upward swing in labor productivity growth is adding a lot of economic strength to the U.S. economy, okay? But here, this chart here, that this is just for fun, because we know that labor productivity usually is negatively correlated with inflation. In other words, if you have a big spurt of productivity growth, usually it corresponds to declining inflation. I'm just looking at this chart here as a confirmation whether what I talked about is right or wrong. It turned out to be that actually these 2 series collaborate each other pretty well. In other words, when productivity bottomed, that's inflation actually topped out here. But the bottom line here is, keep in mind, mean reverting process of productivity growth, that is another reason that actually has added a lot of economic resilience to the US economy. The third factor, the final factor here, is right here on your right hand side. Look at the chart here. There has been a manufacturing investment boom as a result of this so-called onshoring process. If you look at the red dotted line, that is a fixed assets investment in manufacturing. Here, this is only structures, meaning factories, workshops, things like that. This does not include equipment. As you can see, the red dotted line that actually more than doubled in 2 years. That is a pretty significant change. But of course, this is a very narrowly defined series. You can see here on your right-hand scale that the amount is still small. We're talking about 70 billion all the way to 150 billion for a 26-27 trillion dollar economy. That is a trivial amount. That's why I'm looking at this blue line, which is the corporate sector as a whole, the fixed asset investment. That is the blue line here. You're looking at the left-hand side scale. That we're talking about $1 trillion here. Now, for the last 2 years, the blue line actually increased by about 28% for the last 2 years. That is quite significant amount. But I think this has everything to do with this CHIP Act that has induced a lot of corporate investment, onshoring, and things like that. The bottom line here is this. These are three sources of very unusual, three very unusual sources of economic growth that I think have explained what has been going on in the US economy. The key thing here to remember is all of these three sources of economic growth are independent of interest rates. Think about it. The fiscal expansion has nothing to do with fiscal policy, no matter what you do, has nothing to do with monetary policy. No matter how high the Fed is trying to push up interest rate, fiscal expansions are happening. It doesn't really depend on anything on the Fed policy. If you think about this mean reverting process of productivity gains, it is an inherent tendency. If you bring down some series too much, the things that they tend to revert back to is historical mean. And that is also very independent of Fed policy. And of course, under normal circumstances, you would think that this fixed asset investment has something to do with Fed policy, because usually when the Fed tighten monetary policy, drive up interest rate, you would expect that fixed asset investment is going to go down, because the tendency is that people tend to save more and invest less. But the problem here is this is a geopolitically driven process here that is completely ignore the Fed policy. Importantly, if you think about this CHIP Act, there's very smart designed. The whole package is very designed very smartly, because the Biden administration is really trying to get some leverage. Just to give you an example, if you look at if you look detail into the package, for example, TSMC trying to build up the factories in the US, the chip factories, they basically present about $1 trillion of subsidies to TSMC, but the TSMC is not going to get that $1 billion subsidy unless the companies put up $2 billion of investment. Unless the investment is put into place, they're not going to get any subsidies. That's why the whole package is designed to get some leverage, and actually, apparently, it is working. So the bottom line here is these three things actually explains why the U.S. economy has demonstrated very unusual economic strength, and these strengths actually is completely independent of Fed policy. Now, let me go through the second issue, which is, so what? I mean, what is the market? Got to be market consequences. What are the market consequences of this? So
I can think about two major consequences right here. If this is a real story, you can tell me that, Chen, this is completely nonsense. But if this story captures the reality, then the natural conclusion here is that rates are held much higher than they would otherwise, period. Because the Fed basically have to raise rates to a level that will compensate not only the private sector strength, but also fiscal expansion. So you have to think about monetary policy to take into consideration of what is going on in the fiscal side. Of course, they have to raise rate to a level that is much higher than they would otherwise. And this is precisely, if you look at the chart here on your left-hand side, I'm looking at the TIPS yield. This is 10-year TIPS yield. This is about 3 sigma overshoot. That actually fooled me into believing the beginning of this year that there's no way that U.S. economy can afford such an enormous increase in the real rate. Basically, it tells me that monetary policy is extremely tight. But now, if you think about fiscal expansion on the background, actually, it's probably not too expensive because, hey, you got a fiscal policy that is canceling it out. The bottom line here is the first consequence, of course, is rates are held higher than they would otherwise. I want everybody to remember that. The second consequence is this so-called divergence between equity and bonds. If you look at the chart here on your right-hand side, think about the blue line as bond prices, because the blue line is inverted U.S. 10-year Treasury yields. Think about that as bond prices. So most of the time, if you think about inflation time, bond prices and stock prices are positively correlated, right? Because every time the yield's going down, stock prices are going up. Prices are positively correlated. But hey, since the beginning of this year, you can see these two things have gone separate ways. Why is that? Well, if you believe the 3 reasons that's supporting growth, and these are 3 reasons that depresses bond prices. But at the same time, these are the 3 reasons that actually push up stock valuation. Stocks, don't forget, stock like growth. And all these 3 unusual sources of economic growth are very well liked by the stock market. That's why you have this divergence. So the bottom line, Dave, 2 important consequences that I want everybody to keep in mind. Number 1 is rates are held much higher than they would otherwise. And B, divergence between the equity and bond correlation.
Thanks, Chen. If only our job as strategists was to predict what has already happened, that would be a great explanation that fits the facts. Question is, how long can these sources of growth, these 3 things that you pointed out, how long are they going to last? I think if you get that right, you can get markets right. But tell me what you think that might mean for markets and our view at Alpine.
Yeah, that is a very, very tough question, but I have to answer that. We have to have a view on these questions. So now, if you think about the fiscal side, I think the spending increase that is the leading factor that actually explains the fiscal stimulus. So I think that spending increase, the jump, the surge, has everything to do with this implementation of these 3 spending packages that are passed before April last year, when the Democrats still had a control of everything, the White House, the Congress, and the Senate. So I don't think there'll be any new packages will be in the pipeline. And most importantly, once we jacked up spending, once the initial impact of these 3 spending packages being in the pipeline, I think on the net change basis, net rate of change basis, which is important for GDP, most likely is going to die down. That's our hunch. But of course, there is a lot of complexity here. We don't know the sequence of these 3 spending packages, which one was implemented first, which one was implemented second. We don't know a lot of details. But I think the hunch is that as time passes by, the net push, the net change of fiscal deficit is going to slowly diminish. So I would say probably sometime first half of next year, the net thrust probably be gone. That's my hunch. There's no scientific proof whatsoever, okay? So that's the first thing that I can think. Now, this is a very important judgment call. If that is right, we may end up with some kind of a perfect storm sometime 6 months. Why I'm saying that? Well, if this hunch turn out to be a right one, then you may very well leaving an economy where the rates are way too high, right? Because as I said, I just repeating myself many times, if this is a true story, that rates are held today much higher than they would otherwise be, meaning the economy probably, the equilibrium rates actually probably a whole lot lower than what the rates are today. So that's why I think if you have a sudden withdrawal or gradual withdrawal of fiscal stimulus, then the rate might be over time becoming too high for the economy. That's probably causing some growth concern going forward. That's the reason number one. What I'm saying, 6 months I might have a perfect storm. Another factor here is monetary policy. About 3 months ago, I wrote a piece that says disinflation so far has nothing to do with Fed, which caused a lot of people are raising their eyebrows, saying, "Hey, what the hell are you talking about?" I'm saying what I'm talking about is a very simple fact. If you look at the Fed policy here on the left-hand side, the Fed actually started raise interest rate about 18 months ago. If you look at core PCE inflation, it peaked out. About 18 months ago. So in other words, they moved almost in the same months. The Fed raised the inflation already topped out. How possible that has anything to do with the Fed? We all know the monetary policy works with a long and variable lag, and then they, if the day that you raise rates, the inflation already topped out. So that actually is the first thing you have to raise some suspicion here. And then if you look at the chart here on the bottom panel here, acyclical inflation, as Dave said, acyclical is basically San Francisco Fed. They decompose core inflation into two components, acyclical and cyclical. Cyclical, basically, they define that as demand-driven, which is the blue line on the top panel. And acyclical is the red dotted line on the second panel. The supply side, the supply-driven inflation is already back to 2%. Come on, okay? So the cyclical inflation, which is the demand side, demand-driven inflation, is only beginning to turn lower. So after 18 months of very aggressive monetary tightening, the cyclical inflation is beginning to turn lower, okay? I would venture to say, even if the Fed doesn't do anything today, even if the Fed policy is still at zero, we are probably dealing with the same inflation. We're probably dealing with the same level of inflation as today. No change because, hey, acyclical inflation is the driving force. The driving force of disinflation so far is almost nothing from the demand, the weakening demand that are actually pulling down inflation. That's what I'm saying. Of course, if the Fed is still holding rate at zero, the long bond yield probably hold on higher because inflation break-even rate probably going to go unhinged. But the bottom line here is, if this is a right judgment, into early part of next year, we will be 22, 23 months into monetary tightening, okay? I use my ruler. I calculated the U.S. Time lag in the between monetary tightening and inflation topping out. It's 22 months, okay, plus minus. So what I'm saying here is you have withdrawal of fiscal stimulus, disappearing fiscal thrust, and then you will have intensification of monetary tightening that is going to be felt by the economy more. So that's what I'm saying. We continue to stick to the view that inflation probably going to fall much faster and harder than most people anticipate because of the time lag. Is right. Right now we're beginning to see the topping of demand-driven inflation, and probably 3-6 months out, that component is going to be becoming much more problematic. Okay. So the bottom line here is, if you got this two things together, you may actually end up with some kind of a perfect storm. Particularly if you look at the economic response too, you can see the chart here on the labor market. Dave mentioned that the problem is cracking. I won't say that it's cracking, but hey, it's clearly softening. So the bottom line here is, from the investment strategy point of view, we were very bullish on stocks all the way to July. We tuned down our bullishness. I think 6 months out, we'll probably continue to tune down bullishness and bump up our duration. Probably the judgment, our best guess is that probably there will be a period, I don't know how long, that equities will underperform bonds. I think that period probably be anywhere between 3 to 6 months out. That's where I'm at in terms of strategy.
Richard, good morning. I can see you on the line.
Super. Good morning, Eugene. Can you hear me?
Yeah, fantastic. Right, so we are still live. We're still going. Richard, I think we should continue if you are ready. To our audience out there, we're moving over to a Global Equity Outlook. Joining us now is Richard Cardo from Investec. Richard, thank you so much for joining us. Your presentation is up and ready. Olga can drive the slides from her side. If that's fine with you, you can just give us an indication when you want to move on to the next slide. Is that fine?
That's perfect. Thanks, Eugene.
Thanks, Richard, for joining.
Super. Well, welcome to everyone. Lovely to be joining you from a hot and sticky London. It's certainly not built to deal with the hot weather in the UK, I'm afraid. My name is Richard Cardo. For those of you who don't know me, I'm the co-fund manager of our Global Leaders Investment Strategy, and I'm going to discuss today with you how we go about choosing stocks and how we currently positioned in our fund given our view on markets. If we can just move to the next slide. So a little bit about ourselves, Investec Investment Management. We have a 15-year track record of managing money. We have an excess of 220 billion Rand in assets under management across various mutual funds and unit trust funds, both in South Africa on the BCI platform and offshore on our Guernsey dollar-denominated platform. We offer an integrated global investment offering across all asset classes and geographies, and we very much believe in offering distinctive investment solutions and a client-centric approach. We are also signatories to the UN's Principles for Responsible Investment, and various of our funds have achieved various awards, such as Raging Bull for performance. If we can move on to the next slide. So a little bit about ourselves, and this slide really tries to capture our approach to managing money, which can best be described as tapping into stocks that offer sustainable growth or quality at a reasonable price. We have over $1.1 billion in assets under management in the strategy across segregated portfolios, a dollar unit trust fund, and obviously the BCI Rand fund version. And we very much believe in the Warren Buffett approach to managing money, which, I think is well captured in this quote. The best business to own over an extended period of time is one that can employ large amounts of incremental capital at very high rates of return. So we're looking for those businesses with investment moats that can compound and endure those advantages over time. We believe those generally will reflect in superior quality metrics over the long term, which in turn will drive share price performance over the long term. Just in terms of what those quality metrics are, well, we're looking for high and improving cash flow return on investment, persistence of profitability, high and improving margins, and stable and sustainable earnings growth. Our investment approach on the top part of this slide, we also show that we're looking for value creating businesses. So what do we mean by that? So those are businesses that in simple terms can generate economic returns in excess of their cost of capital. Have they demonstrated an ability to grow profitable businesses and or the willingness to shrink bad ones? Just as important for us is the management team that is managing the business. We look for managers with high integrity. They need to be disciplined operators, good capital allocators with a long-term vision. I mentioned there that we also look into structural growth investment themes that we believe are going to change the way we work, consume, and act. And I'm going to touch on that in a little bit more detail later on. Just in terms of what we look to avoid, we typically don't invest in businesses that are highly cyclical, overgeared, which are structurally challenged, or where we just don't understand the business model. In terms of our investment process, that's captured in the bottom part of the slide. We very much follow a top-down, bottom-up approach to managing money. From a top-down perspective, we're looking at those elements that we think will drive economic growth. Our Global Investment Strategy group gives us guidance there. But the bulk of the work is really done from a bottom-up, fundamental, research-driven approach. We have a 12-person strong in-house proprietary research team that sits across the UK, Switzerland, and South Africa, and they cover all industries and sectors. we also buy the best third-party research that is out there in the market. And first and foremost, we use Holt's cash flow return on investment framework to narrow a universe of quality stocks that we look to invest in. That universe typically boils down to about 120 stocks. And, you know, from there, we look to construct a portfolio of high conviction, best ideas, typically comprising 30 to 40 stocks, 2 to 5 position sizes per stock. And we have a high active share ratio. It's north of 80%, and we invest for the long term. I mean, if you look at our turnover ratio, it's typically below 15%. So we invest with patience for the long term. These are typically larger cap companies, $5 billion market cap or more. We prefer to invest in developed markets, given that we know their accounting standards. We're comfortable with the liquidity, transparency, and regulation of those markets. But because these are multinational champs, you know, you are getting exposure worldwide, and you'll see that later on. Just to mention that although it's not an ESG offering or fund, our US dollar fund version does have a 5-star Morningstar rating for ESG sustainability. Okay, flip to the next slide, please. I thought I'd show you in practical terms, you know, a lot of what I've just spoken about. So, you know, what we're doing here is looking at Adobe, which is the global leader in digital media and marketing, creative software. They've got a huge market share. They control north of 50% of the market. And their brands are well known and trusted. You'll have come across Acrobat, Photoshop, Illustrator, PDF, Flash, Dreamweaver, and the like. So they're well known. Like other software businesses, it's very capital light. It's a subscription revenue model which generates recurring revenues, and the company has high pricing power, which allows it to drive those high margins, which is one of those quality metrics we look for. And you can see that in the yellow bar graph on the right of the slide. You can see operating margins are well north of 50%. They're very stable, and they have been increasing over time. The company is also highly cash generative, another quality metric we look for. And you can see that on the top of the slide. The blue bar charts are the cash flow return on investment generated by the company, or the economic return, relative to the green line being its cost of capital. And you can see how the cash flow return on investment has increased over time, well north of 40%, and well in excess of its cost of capital. And it's been improving since 2013, when they changed from a revenue model, which was largely upfront on premises based, to, as I mentioned, a recurring subscription revenue model. Just in terms of some of the secular growth trends that I mentioned, we look to tap into. Well, Adobe is a great play on some of those, consisting of obviously of artificial intelligence, computing power, virtualization, and individualization. Just in terms of AI, I mean, Adobe has been using AI tools embedded into their creative software for the last 10 years, Firefly and Sensei to name but two, and they have a very clear roadmap to monetizing those AI tools. So it's not just hype and exuberance. These are AI tools that, you know, they are generating revenues and profit from, and are becoming increasingly entrenched into their various brands, which are trusted by the market. So that's kind of the enduring source of advantage. You know, to paraphrase Jeff Bezos, you know, what was the opportunity? Well, for us, the opportunity was in 2022, when you know, Adobe announced the potential acquisition of Figma, which is a private company, a competitor, for $20 billion. The market didn't like it. The share basically halved. The market thought that the acquisition was too expensive, and were obviously worried about why Adobe would be looking to potentially, you know, buy its biggest competitor. We saw that as a potential opportunity, given some of those structural growth themes and quality metrics that I had previously mentioned, and we added materially to our position, which has subsequently, you know, doubled since 2022 fall off. So that's Adobe. I mean, if we move on to the next slide, talking about high free cash flow and high returns on capital being rewarded over time. Well, this is from empirical research, one of the houses we get research from. And on the left-hand side, they've looked at large cap stocks in the US over the last 10 years. And effectively what it's showing you is that stocks with high free cash flow margins outperform stocks with the lowest free cash flow margins by a considerable extent. And that level of outperformance increases over time. And similarly, on the right-hand side, they did the exercise for stocks with high return on invested capital to stocks with low return on invested capital. And again, history has shown that over time, stocks with the highest return on invested capital increasingly outperform stocks with lower return on invested capital over time. Exactly the kind of metrics that we're looking to invest in. If we can move on to the next page. That's kind of the rogues gallery of investment managers. Myself and Andrew have been managing the strategy since inception in 2014. We're both based in the UK. Oliver on the right-hand side came in about halfway through, and he's based in Johannesburg. On the next slide, we'll see the various members and the bios, qualification, and experience of our 12-person strong research team. Again, they are located practically in various geographies. We cover all the main sectors and industries, as I previously mentioned. If we can move on to the next slide. So just to summarize very quickly our view on markets before showing you how we positioned given our view, we believe that the Fed hiking cycle typically leads to an economic recession. Now, if you look at the last 14 Fed rate hiking cycles, we've seen a recession in 11 of those 14 cycles. We're starting to see tighter lending standards from banks. Loan demand is lower and slowing across businesses and consumers. And obviously, higher financing costs are order of the day. And we think all of that will ultimately result in slower economic growth and possibly a mild recession. More lately, economic surprise indices have been weakening, particularly manufacturing, which is below the sort of 50 level, the PMI manufacturing number for contraction expansion. Chinese economic growth, second biggest economy, responsible for north of 40% of global growth over the last few years, has been particularly disappointing, as has the stimulus that we've seen from both the central bank and policymakers there. There's no doubt that China faces various structural headwinds, ranging from high debt levels, deflation, to an economy that is too narrow and focused on the property market and exports and infrastructure. And we're very cognizant of that backdrop in terms of how we invest. What's really kept the economy afloat to date has been the resilience of the US consumer. But I think there are two things that suggest that might start to falter and are indicative of our view on the economy going forward. One is the excess savings levels that we saw out of COVID, which has kept the US consumer afloat. That $2.5 trillion has very much been depleted. That's no longer there. And secondly, the labor market, as we heard earlier, has been particularly strong and tight, but we are starting to see some cracks in that currently. So, for us, the most important thing is to look at the yield curve. That inverted in October last year. Typically, based on history, you get a recession within 12 months of that. The leading economic indicator is also firmly in the red, has been for a while, and we think both of those are fairly ominous. The positive news, though, is that inflation is moving lower. Rates, we think, are peaking, very close to peak, but probably will stay higher for longer, and that bond yields will likely fall from here. And please remember, this is all within a backdrop of high geopolitical risks. We know what's going on in Eastern Europe, Russia, Ukraine, and increasing saber rattling between China, Taiwan, and the US. Okay, if we move on to the next slide and drilling down into the equity market itself, valuations are full. So there's no cushion, there's no safety net. On the left-hand side, we look at what 12-month forward PEs were in various geographies at the beginning of this year and where they are now. So the US stock market has actually re-rated from a PE 12 months forward of 16.9 times at the beginning of this year to the current 19 times. And that's in the context on the right-hand top chart of long real rates in the States having increased by 60 basis points this calendar year, which is an anomaly. Typically you can see on the top right, the 12-month forward PE, which is the black line, moves in tandem with US 10-year real yield inverted, which is the blue line. So in other words, where real yields are negative or moving lower, the stock market re-rates, and conversely, when real rates are moving up and going positive, the stock market tends to derate. But we haven't seen that this year. And similarly, if we look at the last 20-year, average multiples for both the US and other geographies around the world, a typical 20-year median P ratio for the US is about 16 times. And as I mentioned, we're currently north of 19 times. So at best, we think, in a recessionary environment, that market should be trading closer to 16 times. There is more value elsewhere around the world, particularly amongst international equities. Europe trading on a 12-month forward P of 12.2 times is lower than its 20-year average. And that very much shapes how we're thinking about positioning our portfolio. If we move on to the next slide, it's also been very interesting to see how earnings expectations have held up. So, on the right-hand side, we look at consensus sales growth and earnings growth projections for the next 2 years across various geographies. The market is expecting flat earnings growth in dollars this year, low double digits next year. We think that's too optimistic. In fact, earnings revisions more lately have been moving negative. Those are the gray bar charts on the top left-hand side. But the blue line is the stock market. So, typically the stock market increases when you've got positive earnings revisions, but the stock market decreases when you've got negative earnings revisions. Well, we're starting to see those negative earnings revisions, and yet the stock market has done particularly well this year. I think one of the key aspects that may lead to some sort of earnings recession is the fact that operating margins in the US in particular are starting to wane. And that's because pricing power, inflation, which has helped pricing power, is starting to wane. So, we're watching those margins very closely for signs of it potentially leading to some sort of economic recession. If we do get an earnings recession on the next slide, well, Morgan Stanley shows us on the next slide, typically to what degree earnings can fall peak to trough in recessionary environments. So, it's looked at all other previous economic recessions dating back from the 1950s, and on average, earnings tend to trough at around 16% year on year. As I say, earnings revisions have only moved, slightly negative more recently from their peak last year. Earnings probably down about 5-6%. There's certainly more potentially to come if we get an economic recession. Let's move on to the next slide. So, how do we position? Well, this chart's quite interesting. It's from JP Morgan. The blue line shows you the extent to which cyclicals, excluding tech, have been outperforming defensives. So when the blue line's moving up, cyclicals are outperforming defensives. When the blue line's moving down, defensives are outperforming cyclicals. And it maps it against the US ISM manufacturing index, which, as I mentioned, is down about 10% year on year. Manufacturing PMIs are in the negative. But we've still seen cyclicals outperforming defensives this year. That blue line's been going up, notwithstanding manufacturing, the back line being in the doldrums. So we're pretty cautious on cyclicals going forward. Our preference is to be in defensives. We think that gap will narrow, and there is scope, we believe, for negative operating leverage to come, given the backdrop I painted earlier within some of those cyclical stocks. On the next page, a very interesting exercise. On the left-hand side, the National Bureau of Economic Research has divvied up, stages of the economy into expansion and contraction. And what it's really showing you is that quality stocks, quality as an investment style, typically outperforms other investment styles in the early contraction and late contraction stages of the economic cycle. Intuitively, that makes sense. Value and cyclicals tend to perform better when the economy is expanding. Well, if our view is right, money supply is contracting. We heard that from the economist earlier on. We think bond yields will fall. That is not a good environment for value and cyclical stocks, at a high level. and typically quality stocks do better in that environment. And similarly, on the right-hand side, what we've looked at there is how different investment factors or styles perform between the last Fed rate hike and the first Fed cut. Now, we think we're very close to the end, maybe one more to come in terms of hikes, and then a prolonged period of wait. And typically in that kind of scenario, excuse me, quality has outperformed all other investment styles. So again, it speaks to why we think our approach should do well given our view on the economy. If we can move on to the next page. We're looking at it a different way here. So what we're doing here is looking at various sectors of the equity market and how they've performed on the left-hand side in the 3 months after the last Fed hike. And you can see healthcare, technology, and staples towards the top on the blue charts are the best performing sectors, whereas materials considerably lag towards the bottom. And similarly, on the right-hand side, JP Morgan have done the exercise at looking at what sectors do best between the recession start date and the point of maximum yield curve inversion, which, as I mentioned earlier, was October last year. And typically you can see staples and healthcare towards the middle of that slide on the right, or chart on the right, are the best performing sectors in that kind of economic environment. And that's very much how we positioned. We have big overweight positions within healthcare and staples. I'll chat to that just now. And we have a big absolute holding in technology of about 20% of the fund. Let's move on to the next slide.
Richard, Eugenia, sorry to interrupt.
Sure.
We're short on time. If you can maybe just wrap up on your portfolio holdings and where you are now.
Perfect, Eugene. So, just to summarize in 1 minute, we are overweight Europe. We think it's too cheap. The US is trading at a sort of cyclical PE and earnings high. It's not just a global offering. If you look at the revenues that these multinational champs, where they generate them, it's all over the world. So about 30% of the revenues of the companies we own are generated in emerging markets in Asia. If you just flip forward a couple of slides, that slide there shows you our top 10 holdings. If you go back one, big absolute positions in some of the tech names like Adobe, our biggest active holding, Microsoft, Apple, Palo Alto Cybersecurity, just outside the top 10. Our preferred consumer names are Apple, JP Morgan, and Amazon. And we're still backing the life sciences and diagnostic names, Danaher, Thermo Fisher, which we've held for a long time, both in our top 10. The stocks of note that we don't own are NVIDIA. We just find it too expensive. Obviously way ahead as a beneficiary in AI. Would have been great to have been in it. It's hurt us that we haven't owned us. But as I said, we're looking for companies at a fair price, and we just don't think that's a fair price. Tesla's the other one we don't own, and Meta and Netflix, other notable absentees. So that's really the portfolio, Jean. Thank you. That was a whistle-stop tour. Thank you for your support, and we're always available for any questions going forward.
Thank you so much. I know it's a bit like speed dating. Huge amount of information in a very short space of time. There are audience out there, the Investec BCI Global Equity Funds are available on most platforms. There are some comments from the audience as well. We are going to make all these slides available to you, as well as the recording. And if you want to get more information from any of the speakers, including Richard as well, you're more than welcome to contact us. We'll put you in contact with them and we can chat through the investment process or get more information on their fund. Richard, thank you so much for joining us, and sorry for rushing you along. Like I said, we are a bit rushed for time. Thank you so much for coming on this morning. We really appreciate it. Thank you.
Pleasure. Thanks, Eugene.
To our audience out there, it's a pity that we did lose Shen. So what we will do is we'll try to get a hold of a recording or webcast of his presentation and send it on to, I think there's a couple of questions from the audience as well. We'll pass that along to the Alpine Macro team and try to get a response on that for you as well. Moving along, our next speaker, Phil Rose, all the way from Jersey. Phil, thank you so much for joining us this morning as well. from Martello Asset Management. Phil is also the Chief Investment Officer and founding member of Martello. Phil, thank you so much for coming online today. We're really looking forward to your views and how that plays out in the Martello Global Equity Fund.
Thanks very much. Good afternoon, everybody. It's great to be back here again. Last time I spoke, I think, was back in May when I came over to your conference, and I used the theme, the 2020s labyrinth. And I'm just going to sort of build on that a bit further. You know, how have things changed? Where are we? What are we doing? Where are we going? Before you message Eugene, this is actually a maze, not a labyrinth, but it's just a pretty picture, eh? And it gives a similar story. So that's where I'm coming from. Let's go to the first slide. China, my notes say China. What can be done about China? China was supposed to be one of the exit solutions for the world to keep GDP growth going and keep everybody sort of working efficiently and everything going nicely. Thank you very much indeed. But it's all gone a bit Pete Tong. Industrial production's falling short of expectations. Retail sales are falling. Property developers, I think that's been in the news almost every day. Property developers are in deep, deep trouble. Exports are contracting somewhat. GDP is coming out less than expected. China's in danger of being overtaken. Also, we've seen in the news, certainly this side of the world, India is sweet talking everybody. Almost every country in the world is walking through India and then spending hours and days talking about trade agreements and goodness knows what else. India is really taking ground currently. Property defaults. They could impact around the globe more than we think. We don't know, and it's very difficult to find who has exposure to Chinese property development companies, and their debts are simply enormous. There's also companies this side of the world and our side of the world that are exposed to China. BHP, miners, 50% of their revenues come out of there. Rio Tinto, 45%. Swatch, they make watches. Rado, Omega, Tissot. That's 40% of revenue. BMW sell a lot of cars over there, 20% of revenue. If China doesn't do what it's supposed to do, it's going to have ramifications elsewhere. Next slide, please. Thank you. I put this together actually, and then when I saw it, I thought, gosh, this is actually quite an interesting slide. What it is a small group of companies, the S&P 100, which is a sort of super large cap, less the return on the broader market. So it kind of highlights periods where the markets have been driven by small clusters of companies. Now, as humans are humans, we name all these things. We've got the TMTs, if you remember that, tech, media and telecom. We've got FANGs, we called them, Facebook, Amazon, Netflix, Google. We then had BRICS, Brazil, Russia, India, China. Now we've got the Magnificent Seven. Sounds like a film to me, but anyway, the Magnificent Seven: Apple, Microsoft, Amazon, Google, Nvidia, Tesla, Meta. These events that have happened periodically through time, they cause huge distortion in the markets and a heck of a lot of pain when they unwind. Now, this is beginning to unwind now. So we can see the peak that we've seen in 2023 is beginning to disappear. The market is broadening out a little bit. But look at the dates: 1987, 2000, 2008, and way back in 1982. What I'm not trying to say is this is an example of something bad on the way, because I agree 1987, 2000, 2008 weren't the best times for investment. But 1982, if you remember that long, sadly, I was in the market in 1982, that was actually the start of something really good. So this isn't an indicator of something happening that's bad, but just shows these times crop up every now and again. You get these enormous distortions and markets led by a tiny number of stocks. Okay, let's have the next slide. Oil. I want to talk about oil. Oil was fantastic in 2022. It was up 65%. The energy companies, oil companies, that sort of thing. They're absolute rubbish in 2023. They've slipped 11% until May. And now they're back on a roll. The producers are cutting supply and they're holding on to those cuts. Demand is kind of stable. And that's creating upward pressure to the price, restriction of supply and stable demand. Oil has gone from $65 to $85. That's 30% increase in 2023. Now, if demand remains stable, oil should remain elevated, and that's positive for the energy and oil companies. And consequently, they have done much better in the last couple of months. However, it does put upward pressure on inflation because the manufacturers and industrial companies, they suck in huge amounts of oil, and so it's inflationary if oil prices are going up. So oil currently is okay. It's doing better in 2023 after a fantastic year in 2022. Let's move on to another theme. Next slide, please. Thank you very much. Banks, not a new theme. Rising interest rates are, however, a bit of a double-edged sword for the banks. You think they make money on increased margins. They do, but potentially they've got higher debts because their borrowers struggle with the higher interest rates. So it's a double-edged sword, interest rates going up for the banks. The last thing the US banking industry needed was the collapse of Silicon Valley, First Republic, and then in Europe, of course, we had Credit Suisse fail and taken over by UBS. That was the last thing the banking industry wanted after going through the whole COVID period and 20, 30 years of almost no interest rates at all to suddenly get a catastrophe. So we've gone, and we would suggest that that's the best place to be, European banks. We've got UBS, we've got HSBC, we've got Nordea. These are the ones that are prospering in 2023. UBS, they've just announced recently after their merger with Credit Suisse that things are actually much better. They're relinquishing their support from the government, and the shares are now up 40% year to date. 40% year to date. The US banks, on the other hand, are up 4.5% on average. So, Europe is the place where the banks are doing better. But I would repeat, the China property debt problem is unknown. Who knows where and who knows who has this debt in Europe and around the world. So it's a very, very difficult situation if you're looking at the banking industry, because somebody somewhere is going to come out and say they've got that debt that you didn't anticipate. Let's move to the next section, interest rates. Let's look at the US yield curves. I've got the 10-year yield shift here, basically, from the beginning of this year and through until now. Since 1950, the inverted yield curve has warned of impending recession, but peculiarly not before that. So 50 years out of 2,000 years of investment, and now we're assuming that that is the norm, and obviously an inverted yield curve suddenly means recession. Well, it might do. It kind of makes sense. If yields longer term out are less, the market is anticipating that economic growth is going to slow, and therefore interest rates are going to have to come down, and that's why you've got this inverted yield curve. But it doesn't necessarily mean it's an automatic thing. GDP growth, particularly in the US, has been really distorted by COVID. Just to give you an example, GDP went from -8% year on year to +17% in 1 year in the US through COVID and then out the other end of it. 2020 saw global economic collapse. Everything just stopped overnight. 21 to 23 saw an enormous recovery. So there's going to be some sort of reset. Perhaps this time around, we will avoid a recession, and that this inverted yield curve will not bring the impending doom that a lot of commentators are commenting on. But you add China into the mix, and it gets tougher still because they're clearly struggling. You add up the excess savings that's been building up in people's bank accounts post-COVID or during COVID, and that makes it even more complex. So again, the situation is very muddy, but we don't personally anticipate there's going to be a recession imminently. There will be one eventually, but not imminently. Let's have the next slide, please. Let's look at markets. We've got a couple of comments on Europe. Europe markets were largely ignored for about 10 years. And then suddenly they came to life. Europe in the last 12 months is up 40%. US up 27, UK 26, Japan 29, emerging markets 15. Europe has done far better than the other markets in the last 12 months. Where's the money been going? retail, there's luxury goods, LVMH, handbags, posh clothes, all those sort of things. They're made a lot in Europe. Those sort of companies have been doing a lot. Travel and leisure, we've all been out traveling. That's been doing well. Insurance, technology in Europe. There's a few good technology companies in Europe. They've been bought strongly as well. China isn't helping, as the link between the euro and the euro industrials and China is quite strong. So where China is slowing, there is a potential impact on Europe. Also, the Russia energy problem that came up following the Ukraine war, with gas being turned off and oil being cut off and all that sort of thing, has caused huge uncertainty for the European companies. The Europe versus USA investment story is not quite so clear cut as it was 12 months ago. There's some fantastic world-leading companies in Europe, but the differential in the valuation is less. It's not quite such an easy decision. So just be careful. And if you're looking at Europe, you've got to find quality. I think that came up in the last talk as well. Quality. You've got to look for quality. Let's look at the next slide. Let's break down Europe. So where in Europe is the money coming from? It's actually quite wide. Breaking down by country, you've got Germany, France, Netherlands, and Spain all prospered in US terms in the last 12 months. So it's not just one European market. Money was pouring into Europe. Some of the companies that benefited: SAP software, Airbus sort of defense, LVMH is luxury goods, ASML make the machines that make the chips that make the world go round. So ASML in the technology side. Amadeus in Spain, they make software. So some of these companies are world leaders and they're doing really well. But stock selection is vital. And it's really important to get the right names in the European market. Let's go forward. Thank you. Just a few names we've got in our portfolio. It's not true to say markets have been as difficult and it's impossible to get returns. Here's a snapshot of the returns. I'm not going to go through them because I'd rather go to the next slide. But do look at European markets and see what's moving. Okay, sorry, yeah, I did say next slide. You're quite correct. Okay, this is kind of smudge graph of our asset allocation since 2019. We've got all the different sectors there and where we've moved, and I've highlighted some changes here. It's really important to move forward and then review what you're doing, making sure your decision processes are right. Are you getting it right or are you messing up? So we do this constantly. So one, we reduced discretionary in June 2020. Well, actually, the world shut off. So it was a fantastic time to reduce discretionary stocks. Number three, we added energy in August 2021. That was probably quite early for a lot of other people, but energy did absolutely fantastically during 22. So it was a great time to add energy stocks. We reduced we reduced technology in May 21. Technology fell about 30% in 2022. Again, in hindsight, did we make decisions that added value to clients' portfolios? Yes, almost certainly. One other one, we added communications in August 2020. What were we doing in August 2020? We were sat at home. In the middle of COVID, we were looking at Zoom, Facebook, Netflix, all communication stocks. So again, looking back in hindsight, they weren't bad choices to make. And it's really important that you do that when you're doing investments, just to review what your decisions are and whether they were successful or not. Next slide. This is a list of changes in exactly the same sort of way. It's a really important discipline. Review your decision making. No one gets it right all the time. Not all these decisions were the perfect decisions at the perfect time, but knowing what drives your decisions and how successful those decisions are is really important for any investment manager. You have to know how many decisions you're getting right and whether there's a way of not necessarily changing, but fine-tuning your investment process to get more right than you get wrong. And if you can do that on a yearly basis, by and large, you end up better off as a result. Let's go on to the final slide. Just a summary. Actually, my colleague, Gary, he might be in the room, but if he is, thank you, Gary. He put the picture on the slide here of the woman in the plane. And I said, what have you put a woman in a plane for? He said, because it fits in with the theme. She's guiding you to the exits. The exits are on the left and the exits are on the right. I said, actually, it does fit in with my themes. Where are the exits to this labyrinth? I said, but unfortunately, the next thing she said is, if we have a hard landing, your life jackets are under your seat. And that's perhaps not the message I'm trying to get across, but it is appropriate. We need to be really careful at the current time. So the summary is China is of concern just now. The US is doing okay, but rates are beginning to hurt. Be careful of that. Rising oil is inflationary. It might damage any future recovery. 10-year US rates are still climbing and they're holding above 4%. That's not great news. Be careful of China's impact on Europe. Watch for deterioration there, because that's going to not have a knock-on effect around the world. Banks and China property. Who has the debt? That's what I want to try and find out next. Equity markets are beginning to broaden. That's great news after a really narrow leadership by the Magnificent Seven. There are opportunities out there. Dispersion of valuations exist. You can find good companies that are not trading on as high valuations as you think. And we don't believe recession is just about to happen. It will happen after a while, but we still think there is opportunities to be found. That kind of brings me to the end. So I will pass back to Eugene, and I think I've probably just about squeezed in the right amount of time there.
Oh, you were perfect on time. Thank you very much for that. Very insightful, and I think you actually made the point right at the end. You answered the question that I had, and it's always about how do you position the equity fund if there appears to be more headwinds than tailwinds, but it's exactly that. Equity markets are beginning to broaden, and you need a fund manager that can actually find those opportunities for you in an actively managed fund. Just a very quick question, Phil. On average, what is the turnover in your equity fund?
Now, yeah, that's okay. I'll give you 30 seconds on it. I've managed money in the way we manage money now for about 25 years, and mostly the turnover is about 30%, really, really low. Markets in the last 18 months have been lurching from theme to theme to theme to theme. And unfortunately, unless you want to get hit over and over again, turnover has increased. I won't counteract that. That is an inevitable factor of the way the markets have worked. Hopefully that's going to calm down and we'll go back to 30% turnover, which is manageable and reasonable. Markets have been really lurching, and that causes turnover to be elevated necessarily.
Very insightful indeed, Phil. Thank you for a really great presentation as always. We look forward to speaking to you in the very near future again.
Thanks, Eugene.
Standing by and ready to go is Sean Pish. Sean, all the way from London, co-founder and Chief Investment Officer at Randmore Fund Management. Sean, thank you so much for joining us this morning. Really great to have you, and you can start when you're ready.
Eugene, thanks very much for the opportunity, and good morning, everybody. So what I thought I'd do today is something slightly different. You often hear commentators, and we've already heard it this morning, what is the right environment for value investing? We're a value asset manager here. We run a value fund. And so I thought we all understand property. Many of us own property, some lucky enough to have a few properties. So let's use an example in the UK property space and just explain value investing for that perspective. So what we've got here is a property in Belgravia, one of the top suburbs within London, SW1X, and you can see that this property over here is on sale for 43.7 million. And if you're quick with maths, you'll figure out that that's R1 billion. And you look at this and you go, well, it's a very plush property. We've got lots of chimneys for R1 billion. But unfortunately, it's only one row of chimneys. It's number 12. Okay, so what are you getting for R1 billion? What are you getting? 706 square meters. And it seems like quite a high price to pay. But you're not just getting 706 square meters. You're getting a nice fireplace. And that can come in handy in UK winters. And you're getting lots of wine bottles and a lovely dining room with marble floors. And you get a copper bath. And you get a nice swimming pool, lots of marble everywhere. Okay, and you're getting 6 bedrooms, 6 or 7 bathrooms come in handy if you've got 6 teenagers who spend as much time in the bathroom as ours do. And it's a new development. Okay, so you're paying top dollar, it's a quality house, quality fittings and furnishings in a quality suburb. But it's certainly coming at a big price. Now, just down the road in SW1V, what have we got over here? Well, you've also got 7 beds and 7 bedrooms and 7 bathrooms, but you have 5 self-contained apartments. So they're all right next to each other. And this is a redevelopment opportunity. And that's on sale for 2.3 million. Okay, 55 million rand, which is 1/20th of the billion rand that you saw from the house just up the road. Okay, but the difference is with this, you're getting some slippers and a fan, and you're getting an empty bookshelf, and you're getting a not such pretty kitchen, and there's no marble anywhere, and there are no wine bottles and no fireplace, and a garden that landscaper hasn't seen. But this is quality. It's in a quality suburb. It's a nice block of a nice apartment block, but it is a completely different price. It's 1/20th of the price. And so when you look at this and you go, okay, well, what have property prices sold for in this area? Well, 37 million, 8.8, 8.5, 8.6, you can see way above 2 million. And so when you look at this and you stand back and you go, what is your potential financial return from buying a perfect house for 43 million pounds? I mean, if something were to happen and you had to pass away and had to get sold to pay your estate, are you going to find somebody who can pay 43 million? If you had a return, you want double that, you're going to find somebody who's going to pay 84 million pounds for 1 row of chimneys. What's your potential downside? Okay. Whereas, what is your potential financial return if you spend a few $100,000 and you put in a copper bath and you fill it with wine bottles and rip up the timber flooring and put some marble? And what is your potential downside? And that is value investing. How many people would pay 43 million and how many people would pay 2? You can clearly see that your downside is far less with 2 and your upside is far more. And that is all we do. And so, we just look around the world and we look for mispriced assets wherever they are. We don't care about the benchmark. We don't care that, Apple is the biggest holding and Nvidia. We're not worried that we miss out on those returns because we can find returns elsewhere. And we look across the spectrum, large caps and small caps and, in areas that are out of favor. And we just try and invest like smart business people. And we analyze the long-term cash flow stream and we say, how much has this business made over the last 10 years? And what have they done with it? Have they bought back shares? Were those at decent prices? Have they made acquisitions? Did those acquisitions increase the return on assets? Did they, pay off debt? What has happened and what have they done with that cash flow? And we don't like over-leveraged businesses, and that's particularly important in this day and age with interest rates being where they are. And many companies thought that was going to go on forever and have loaded up their balance sheets, put on hundreds of billions of debt. Well, Oracle's a simple example, actually, to buy back shares. What happened yesterday? Oracle was down 14% in one day. Okay, we want management who are on our side. We want management who, we haven't got time. I'm not plumbers. We're not plumbers. We can't go and put those copper baths in ourselves. We need management who are on our side, who see the value and are doing the sensible things. And if it's mispriced, okay, you get a margin of safety. So when we get it wrong, as Phil rightly said, none of us get it right all the time. The key thing is when we get it wrong, we have to be able to correct those mistakes. And fund managers are very bad at that. No tennis player hits the ball over the net all the time. No surgeon gets it right all the time. No advocate or barrister wins every case. Fund managers are no different. We're going to get it wrong. And when we get it wrong, we don't want to lose too much money. And so we must admit mistakes. And so what I thought I'd do here is just take an example. We don't own Walmart. I'll show the next company we do. And so Walmart probably needs a little in the way of introduction. It is a $440 billion company. It is a giant. And they have 630 billion of revenue, okay, 57% of which is grocery and pharmacy. So what else do they sell? Well, home furniture and appliances and electronics and patio and garden and tires and things like that. But 57%, nearly 400 billion is grocery. Now, if you look, but it's a mega cap. If you look here, what you're looking at here is the blue line is the share price and the orange line is their forward earnings per share. Okay, so that's the estimated earnings per share that analysts have. And this is just going back 10 years and fiddled with the dates. And you can see that the share price has gone from, and they're both rebased to 100. So the share price has gone from 100 to 230, but the earnings have only gone from 100 to 130. And what is that? That's 2% per annum growth. And that might just amaze you, because you think, well, hang on, this is the biggest retailer. We at a time when everybody wanted to buy stuff and interest rates have been low and the consumer's been spending. How did this company only grow earnings per share 2%? Well, actually, it grew earnings, didn't grow earnings at all. This is just because of some buybacks that it managed to grow 2%. But what's worrying is the share price increased at 8%, far faster than the earnings level. And why is that? Well, because it's a large cap. And so much of the money in recent years has gone into the mega caps and the large caps, because it's been, those are the big companies in the index. And so those have driven the share prices beyond the level of earnings. And so what that means is that 10 years ago, you paid 14 times for Walmart. Today, you're paying 30 times earnings for Walmart. Okay, now, if I mentioned Walmart and I asked the audience, is this a quality company? I'm convinced 90% probably say yes, and it might be. But the point is, you're paying 30 times earnings for a company that's not even growing. And what is the fastest part of Walmart's business that is growing? It's grocery. Well, let's have a look at Kroger, because Kroger's a 34 billion. It's not a 440 billion. And this is one of our larger top 10 holdings in the fund. And this has got 148 billion. So it's still a meaningful size business, of which 90% is grocery and pharmacy. But you can see on the right here, they don't have autos and tires and all those other things. Okay, and so what have they done? Well, their share price has gone from 100 to 300, just over 320, and their earnings has gone from 100 to 320. So guess what? Their earnings have grown at 12% per annum, and the share price has gone up at 12.6, far more in line. And what does that mean? That means that it hasn't re-rated. You're paying 11 times earnings back then, you're paying 11 times earnings now. Okay, so here you've got a business that is exposed to the fastest growing part of Walmart's of retail for a third of the price. But it's not a giant, it's a mid-cap stock. And that is where we find opportunities. And that is why we own Kroger and we don't own Walmart. And we look around the world, and what's happened over here in recent years is that you're not allowed to pay your brokerage. You can't buy investment research as part of your brokerage costs, which used to happen. And so that means that fewer people have been buying research from brokers, stockbrokers, and that means that they've had to cut staff. And so they just leave their staff to look at the big companies, because that's what everybody's looking at. And that creates opportunities for guys like us who can traffic in smaller and mid-cap companies. And these are not minnows, $43 billion. Now, what Kroger's doing as well is they're buying Albertsons at the moment. They're in a bid to buy Albertsons, which is another big food retailer in the States, and they're working through that at the moment. And there are huge synergies that can take place there. So here we've got management who are doing the stock market equivalent of putting in a copper bath. Okay, we've got management on our side who are doing that, and we're not paying a lot. We've got 11 times earnings. And what are they also exposed to? They're exposed to private label. And in a tough economy, so no name brands, in a tough economy, what does that mean? Well, people no longer want to buy the branded cereals and the branded, deodorants and all the rest. They trade down because it's much cheaper and they get better value for money. And so these supermarkets can get exposure to that. And that is one of the areas and one of the reasons why they've managed to grow earnings faster. Okay, and so here's our performance. We've been going since 2008, and this is with the green line. The orange line is the world index. The purple line is the large cap blend equity. We're a value manager, but this is the biggest component, and there's 1,900 funds which have been in existence over the last year in Europe, Africa, and Asia, and we top percentile over the last couple of years and third percentile since we started. And you can see Morningstar 5-star. Now, what's important, because everybody wants to know, well, what's the outlook and what's going to happen in this region and that region? This has taken place. We've managed to grow our value of the share from our fund from 100 to 427 through many different economic conditions. And if you just think about this period, we've had, that's, the tailwind, the last few months of the global financial crisis. You had the European financial crisis, you had Fukushima, we've had pandemic, record low oil prices, record high oil prices, etc. We still managed to just do what we do, find decent businesses, don't pay too much, admit mistakes when you get them wrong, okay, and just compound through time. And so that is all we do. And in rands, if you translate that into rands, unfortunately with the weakness of the rand, 100 rands gone to 877 rand. If you'd had that in the average fund, it'd be 577 rand. Okay, so I mean, as I said, we value investors, and so the price, the weighted average price earnings multiple of the fund is 6.3, world index 17, and you can see big discounts on all these metrics. But we're not going to look like you're not going to be cheaper than the world index if you look like the world index. And so we have more in Japan than we do in North America at the moment. This is the benchmark weighting, is the blue, the green is our fund. Benchmark in North America, 72%. Our fund, 16%. Why? Well, you've heard from other people who've spoken earlier. The US is expensive. And we can't find value in the US. We find a lot more value in Europe, and we find a lot of value in Japan. And we're not afraid to go where there's value. I mean, if we don't think something's cheap, we're not going to buy it. We're not going to have slightly less than the index weighting and be happy with that. And we do have some in emerging markets, and so that is our positioning. I mean, it might surprise you. We have less than 2% in IT. We have no Apple, no Oracle, no Alphabet, no Microsoft. Why? Because we don't think those things offer value. We don't think they offer value, and we're paying a high price. People paying a high price for future earnings. We have our staples. That is where the food retailers that I mentioned a few seconds ago, and we really like European banks. Phil touched on that a second ago. We think they're very well capitalized. They offer very attractive dividend yields. ABN AMRO is on a 10% dividend yield, 5 times earnings, half book value, and exposed to the Dutch economy, which is very resilient, and you don't have crazy property prices. So we don't have US financials, we don't have real estate, we don't have utilities, and that's how our portfolio is currently positioned. The important thing, what I've done here is how does that blend with some of the other funds that you might have? This is the 5 largest feeder funds in South Africa, and this is the correlation matrix, and you can see, and the world index, you can see that we have a 78% correlation with the world index. Many of these other feeder funds, these large global equity feeder funds, have much higher correlations to the world index and to each other. We have very low correlation with many of them. So, hopefully that can help people diversify their risk without sacrificing return, which has been the case historically. And I want to leave you with the point that overpaying for perceived quality can be expensive. This is over the last year, the world index up 12%. Dollar General was perceived as being a high quality, fast growing company, is down 48%. I mean, Estee Lauder, high quality, annuity income, use the creams all the time, down 38%. PayPal down 37%. Just because you are paying for or buying something that you think is quality doesn't mean you're immune from any declines if you pay the wrong price. And so that's it. We've got experienced decision makers in our team, tried and tested process, generated returns, and very high active share, 99% active share, and low correlation with popular funds. Eugene, that's pretty much it.
Sean, thank you very much for that. Very insightful indeed. And it does show that the process works. I mean, the proof's always in the puddings, and it showed in your performance numbers over time. Very quickly, one of the slides that you show us with your regional allocation, when you were out here in May, you did express concerns about the US, and you also mentioned, that you have very strong views on Japan. Looking at your positioning currently relative to the benchmark, which you obviously don't follow, very strong allocations to Japan. Your views on Japan going forward, I mean, is it a macro argument, or is it just where you find some of these really good quality companies at good valuations?
Yeah, Eugene, they are. It is, I guess, mainly, well, I mean, certainly we bottom up investors, and we find these great companies that have been ignored because, there's often a throwaway comment, oh, Japan, it's got, aging population, bad demographics, don't want to be there. But you've got wonderful companies, and if we can all name I'm sure we can all name 5 Japanese companies that are out there. And what's insightful to me, I mean, you saw that from Phil's slide earlier, is that, the topic since the end of September last year is up 27%, and that's importantly, that is in dollars. So it's up even more in yen, but the yen has been weak. And so there are lots of companies. We've got companies in our portfolio, they've got more cash in the balance sheet than the value of the company. And they are buying back shares. And because it's been ignored, it's less liquid. So if a company comes out and says, we're going to buy back 3% of our shares in issue, what you see is the share price respond. Whereas Alphabet announced they're going to buy $70 billion worth of shares in the last set of results. Okay, share price barely moved. So because it's so liquid, and so it's been an ignored market, and that's wonderful opportunities for guys like us. And you think, it should hopefully it make people aware that in the US this year to date, the US obviously has done well only because of those large companies. Japan has done well, almost as well, but not with no exposure to those magnificent seven. So there's a real underpin. And what's interesting, I heard the other day, is that if you can speak Japanese, you can get a job at a hedge fund over here. Okay, because they are on the hunt and are looking for people to get exposure to that market. So that just shows you that the money is moving in Japan and it's not over.
My Japanese is horrible. I think I'm going to stay right here. Exactly. Other than Godzilla, but that doesn't count. Sure, just very, very quickly. And it speaks to things like currencies. I mean, you did mention that the yen is undervalued, but I think it's more a case of the dollar being overvalued. And I'm going to pass this question to you because I know you've been in London for decades now, but you're still a South African with roots tying back to Old Mutual decades ago, right? So I still see you as South African. New money is coming, to the market from a SA investor perspective. It's always a bit of a conundrum in terms of how we allocate globally, given where the currency sits at the moment. Just your views quickly. I mean, if we've heard all these things now, a lot of headwinds globally, especially in the US, with fiscal stimulus running out, excess savings running out, so maybe things are a bit more dire there. But we've also seen in the past, if you were to go into a global recession or they do hit a speed bump, how money floods back to the US dollar again. Your views quickly on the US dollar. Is it a currency that's going to stay stronger for longer than one would have hoped for?
Eugene, interesting question, and I don't profess to be a currency strategist, but I will say a couple of things. If you are a South African and you're taking your money offshore and putting it in a fund which has 70% exposed to the dollar, or 80% like some funds, your view on the dollar is quite important. Okay, like with us, you take your 100 Rand and put it offshore, actually only 15 is being exposed to the dollar, because you're also buying yen, which itself is weak. So you're getting so you want to be careful. If you don't want to take a currency call, find a fund that's quite balanced in that regard is the one thing I would say. The second thing is I think it might be a little bit different this time. I saw an interesting chart the other day, which was the oil price has historically been, when the oil price is up, what you find is that the Middle East, if you take those super profits and put them into US Treasury bills, they're not doing that this time. Okay, so there are fewer people. I mean, if the rates start going up in Japan, you're going to see the Japanese selling their US Treasury bills and bond holdings and repatriate the money back to Japan, which is going to strengthen the yen and weaken the dollar. Well, we know what's happening between China and the US, and now you've got the Middle East also saying, well, hang on, well, not just saying. I mean, the proof is there that they are not investing their super profits in US Treasury bills. So I don't think a bet on a strong dollar is a one-way ticket. I don't think so.
Very thought-provoking in terms of how you balance out in your fund with currency exposure. Definitely. To our audience out there, the Radmore funds are available on most of the platforms. So if you want to get more information, we can get hold of Sean. I'm sure we'd like to engage with you as well. Sean, thank you so much for joining us today. It's been really great to have you on with us again. And sorry about the rush to cover a lot of information, but we'll keep contact with you and we'll get you on one of your sessions again in the very, very near future.
Thank you, Eugene. All the best.
Thank you. Right, moving along swiftly, global fixed income. Global yields obviously very attractive at the moment in new heights. I've mentioned in the beginning of our session as well. So global fixed income becoming more attractive to a lot of investors, and who better to give us good insights on global fixed income than Mark Seymour from North Star Asset Management. Mark, thank you so much for joining us this afternoon. Really great to have you with us.
Hi there, Eugene. Hopefully I've connected. I just want to share the presentation from my side.
Yes, we can hear you loud and clear. Great for that.
Okay, let's see.
Can see your slides.
Okay. How's that?
Fine, Mark. There's full presentation mode. Absolutely perfect.
Okay, so we're on the treadmill. I see we're covering a lot of ground very rapidly, and okay, so let's make a start. global fixed income, obviously of great interest currently. And as you mentioned, as a function of, sorry, I just want to, okay, there we go. We just got a couple of distractions here. Yeah, so in terms of global fixed income, we've come down a path where yields are starting to look attractive once again, which has not been the case over the last decade. So yeah, I think there's time for global fixed income. Okay, so let's have a look. First slide, this is the team. Lots of experience here. So if you have a look at the bottom row, we've got Adrian, Chlelo, and Marco. They sit on the fixed income committee. We meet once a week, discuss a matter of topics ranging from macroeconomics all the way through to valuations on the different instruments, etc. Yeah, and then on the top row on the daily grind, we've got Sebastian and Rafilo, we've been doing some good work. Just to give you an idea in terms of track record, I joined the industry in 2001, so I go back quite a way. I've worked with Adrian ever since. I've been good friends with Adrian since 1988. And I've worked with Marco for the last 13 years. And then also, if you go back into my early years as a multi-manager, I actually supported Chlelo with money in his standard value fund. So, yeah. Okay, so first slide, this just gives you an idea of our track record. The North Star Income Fund, this is a local fund, just to give you an idea that we've managed to produce decent returns, good risk-adjusted returns relative to peers. And it's the same thinking and valuation and process that we are importing into the North Star Global Income Fund. Okay, so what's the idea? The idea is to provide a solution for global investors who are looking to put money offshore, but not to take on high risk, but to look for a low risk option. And at the same time, to make sure that their returns are protected in real terms. So those are key factors there. Yeah, and I'm sure in terms of the presenters that have presented before me, one gets the sense that there's a great deal of uncertainty. We've come through a lot of turmoil post-COVID, lots of shifting dynamics, yeah, so there's no shortage of uncertainty. Yes, as I mentioned, we're looking for, to provide investors, global investors, with an income which is achievable now, which it hasn't really been that achievable over the last long while. Yeah, and then also in terms of, I spoke about the risk, so it's a low risk option, the North Star Global Income Fund. And finally, we are actually getting some real yields. Okay, so I'm going to talk just very briefly about, so I'm going to step back and have a look at history and look at how returns have been generated over time and essentially what you needed to get right to be able to produce a real return. So in this first slide, it paints quite an interesting picture. You've got US 3-month Treasury bills going back 100 years, set back against the inflation, so inflation in blue, and the yields of those 3-year Treasuries. And what you can see is that obviously there are times when your capital wasn't protected, and there were times when you got really decent real returns. In the 40s, Second World War, central banks held rates at very low levels while inflation raged. That certainly was a terrible outcome for investors in cash. And then more recently, over if you look over the last 60 years, what's quite interesting that is in real terms, these central bank raised rates during the 70s when inflation was raging. And what was quite interesting, at least with rising interest rates, investors' capital was protected to a large degree, except for a short period in the late 70s, where real returns from cash on a 3-year rolling basis was roughly 2% below inflation. Post 1980, it was the golden years for holding cash, and you got really decent real returns all the way up until the last decade. So up until 2010, you got some really decent real returns. But what's quite interesting is that as a cash investor, it's actually been the worst decade in a long, long while. And to give you an idea there, with interest rates being held at zero and with even a small amount of inflation coming through, and then also with the recent spike in inflation, cash investors have actually gone backwards for the better part of a decade. Okay, so what that does is it kind of sets the backdrop as to the urgency of what one needs to do with one's capital if you're trying to protect it in real terms. The good news is that with the latest wave of inflation, the central bank has been, albeit late, they've been aggressive and they have been raising rates. And that has actually now created an opportunity for investors to park cash and achieve real returns. If we switch to the next major asset class, bonds, and here we've got the 10-year US yields versus the same backdrop, inflation. And it's a very interesting picture. You can see, once again, during the 1940s or leading up to the 1940s, decent real returns from bonds. The 1940s was a terrible period once again. The central bank exercised yield curve control and kept those yields out. And so it was once again a terrible investment in bonds during that period. And then to some degree, it wasn't too bad during the 50s and 60s, but certainly going into the 70s, as inflation raged, it was very tough for bonds. Post 80s, similar to cash, it was the golden years once again. What is interesting, though, is that even though yields haven't risen too much in comparison, if you compare it to the 70s, in real terms, this has actually been just as bad as the 70s in terms of real returns. So once again, starting off a very low base, we've seen yields rise from close to zero at the 10-year point to just above 4%. And as a result, bond investors have experienced terrible returns. Okay, so if we're talking fixed income, this is important because most of your portfolio is going to be, you would think, is going to be exposed to cash-like instruments, money market, bonds, etc. And so what we can see is that, depending on where we are in the interest rate cycle, depending on monetary policy, this has a large impact on the prospective return. So this is something that is that definitely is top of mind when managing the North Star Global Income Fund. The next port of call here is credit spreads. So I didn't mention, but I mean, on the previous chart, the good thing is that you've got the 10-year point of the US curve sitting at just above 4%. And, inflation's at a headline level has dropped. So, from that perspective, you're now for the first time in real territory, which is, a point of interest. The only trick is that when you now looking to potentially enhance that yield through some kind of credit pickup, the problem you have is that credit spreads are literally at all-time lows. So once again, if we're looking to generate returns, we understand that there's actually quite a lot of risk embedded in the credit market. These charts and tables just explain how we see value in the US Treasury curve. So if you have a look at the red curve on the chart below, the solid red line, that is where we see fair value 3 years out. And the blue line is the US Treasury curve currently. And so what's quite interesting here is that if we believe that the Fed manages to get inflation under control, and that we do see a series of interest rate cuts in the order of 200 basis points over 3 years, then, if that story unfolds, then returns for US Treasuries should be pretty good. And the top table, what you can see are the prospective returns. So, so roughly just over 4% from cash. And if you look at down to the 7-year points in the curve, hopefully you can get about a 5% annualized return. So essentially what we're saying here is that, provided the Fed gets manages to calm inflation and the world returns to its previous norm of stable, low inflation, then certainly there is some value that's creeping into US Treasuries. But for the most part, from a risk-adjusted perspective, it's really pointing us to the front end of that curve. And then if we switch our sights on equities, also over 100 years, there's a couple of things that come to mind here. So like with cash and bonds, high inflation is a real headwind for returns from all asset classes. So we can see here over the long term, and the early part of this, or if you go back 100 years, you got some pretty decent yields there. And what we note is that historically, at an index level, the dividend yield has ranged between roughly 3% and 6%. That's the one point. The next point is that we can see that when inflation rages through the system, that affects equity markets and those yields rise. And the third point I'd like to draw your attention to is that since the 1990s, as we've entered into a lower inflation environment, it's interesting that at an index level, investors have been willing to pay up for equities and essentially resulting in much lower dividend yields. All in all, what is really attractive about equities, though, is that even though the volatility is higher, from a real return perspective, you achieve real returns on a more consistent basis. So unlike your fixed income instruments, when you have rising inflation, you're on the wrong end for a very long time, and when you have falling inflation, you're on the right side of that equation for a long period of time as well. Whereas with equities, you have far greater opportunities to enter into the market and to realize real returns. Okay, now the important thing is that the question is, in the North Star Global Income Fund, currently we do hold some equities. And the question is, how could that be, given that dividend yields are so low in US equities? The interesting point is that if we can't actually see it here, I'm just going to move this. Okay, so if we overlay the dividend yields on the stocks that we actually hold in the Global Income Fund, what's quite interesting is that the blue line, what you can see is that literally for the last between 3 and 5 years, there's a whole group of stocks that have been derated in the index. And I would argue at this point in time is actually trading on very decent valuations. And if we go to the next slide, that's just a magnified view of the current dividend yield for the equity holdings in the North Star Global Income Fund. So you can see there, dividend yield just under 4.5%. And if we kind of contextualize that versus, history, a dividend yield of between 3 and 6, certainly makes a lot more sense than the more recent period where lower interest rates have essentially forced equity investors to accept much lower equity risk premiums. So I think, from this perspective, if you've got access to the North Star Global Income Fund, the equity portion certainly makes a lot more sense from a valuation perspective. Yeah, and so, if we think about all the things that I've been talking about now, and we say to ourselves, well, how do we achieve a real return of 2% after cost? And you put that through an optimizer. Essentially what it spits out is quite an interesting portfolio, which is basically a mix of cash, a mix of bonds, a mix of equities, and even some alternatives. I haven't spoken about gold, but certainly, an asset class out of those ones that I've spoken about also makes sense from a diversification perspective. And the interesting thing here is probably an important point to make is that, in the world of fixed income, it's difficult to see how you can achieve your return objective of 2% real without taking on some kind of risk. And, you can do that by taking on credit risk. We would argue at the moment, the opportunity isn't very good. You can take on some equity risk. And at an index level, we would say that that is also probably not a good starting point. And that's why it leads to high dividend yielding stocks. And interestingly enough, I was interested to hear the previous presentation, but I'm happy to report that we do own Kroger as well on a very high dividend yield, and we don't own Walmart. Okay, so I've spoken about the construction of the broad idea in terms of how we construct the fund. It is USD denominated, and yes, most of the holdings, not all holdings, but a majority of the holdings are in dollars, and we appreciate that there is currency risk, but holding 10% in gold, I think, gives quite a good diversification, away from the currency risk of being exposed to dollars. And I spoke about the real return target of 2%, and just to contextualize that as well, over the long term, cash has given you 1% real return. Global bonds has given you 2% real return, but at a much higher risk than the way the fund's constructed. And global equities has given you a real return of 5%. With this fund, we set our upper limits in terms of risk at 1/3 of the equity market, and then also in terms of drawdown. But in all reality, we would be disappointed if it displayed that kind of risk. And I would say probably closer to 1/5 of the equity market. So if you think about it, equity market's giving you 5%. We're aiming for 2% at far reduced risk. And so this is how the fund's currently positioned. Interest rates have been rising. That's been very good. For the first time, you can get some yields in short-dated treasuries. So a large part of our holding is in US treasuries. Our equity holding on a dividend yield of 4.4, trailing PE of 16 versus the market, dividend yield of 1.6, and a trailing PE of 24.7. And so the fund currently is on a yield of 4.65. And I think we are well positioned to deliver on our objective. And also, got a great team. All the prospective returns from the different holdings are put into a monthly portfolio optimizer, and we position the fund on a forward-looking basis. And we're pretty excited about being able to, deliver real returns in this space. Thanks, Eugene. I think that's it.
Mark, thank you very much. My side, your bond holding is very interesting, obviously. And I mean, I've seen a couple of calculations on, if you've got a bond yield of about 4.5% and rates could drop by 50 or 100 basis points, whenever that might be. We've all seen now it's likely to only be towards second half or late 2024, rates staying longer for higher, but you do manage the SA fixed income fund as well. We could see some capital gains coming through in the bond markets. Do you think that the US could be in a position to cut rates before SA starts cutting rates?
I don't have a strong view on the timing between rates being cut and between us and the US. I know that we started raising rates before the US started raising rates. I think that wouldn't be a bet that I would want to take. I think, and it's not such a big, it wouldn't impact our valuations materially. I mean, we're currently looking at consensus path of interest rates, and on a one-year view, we expect the Fed to cut rates by 75 basis points over the next year, potentially with a rate hike in November, but then to come down quite aggressively. And I'm just thinking now in terms of our modeling, local modeling, we're not pricing in as many cuts and as aggressively. And we're still getting really, really good valuations out of our local bonds. Yeah.
Makes a lot of sense. And that crystal ball question, sorry to pass that to you. Mark, thank you very much for your time. Really appreciate it. We're really running out of time at the moment. There's a couple of questions there from the audience. I'm going to get those questions through to you if you maybe want to respond on that via email, and we'll get that through to our audience members as well. Mark, thank you so much for joining us this morning. Always great to have you on board.
Thanks, Eugene. Have a good rest of the day. Cheers. And thanks to all the listeners.
Last comment, looking forward to seeing a feeder fund on your global income fund soon. Right?
Yes.
Exactly. Joe, audience out there, we are going to break for two. Right, we are back with the BCI Offshore Investment Managers webinar. Thank you all for still being on the line. We're going to move over to global property, and traditionally global property does very well after a rate hiking cycle and remains a good diversifier in client portfolios. With global property trading at a 15% discount to NAV, it may be time to take a closer look at global property again. Joining us now, and has been ready to go for a while now, is Greg Rawlins from Ritway Global. Greg, thank you so much for joining us this afternoon. I can see your slides, but I can't see you yet. Hi, Greg, are you back?
I'm back, and
yes, fantastic. Got you.
Got you. Okay, there I am. Thank you, Eugene.
Greg, we are ready if you are. Yep.
Thank you, Eugene, and good afternoon to the viewers. I want to open by observing something relatively obvious, in particular to the previous presentations, and that being the good times brought on by stimulus post the global financial crisis, and the COVID era is coming to an end. And inflation at unacceptable levels is now a stark reality for some time to come. The mention of an attendant higher and longer rate cycle will not be out of place either. I recall shortly after the recent Jackson Hole gathering that Bloomberg published an article with the headline, "Powell has got the bond traders where he wants them," full of doubt. And so it should be, as the Fed itself is not sure when inflation will be finally subdued and return to the 2% target rate. So two words come to mind: risk and uncertainty. However, whilst there's no doubt that rates will be higher or longer for more, importantly, they ultimately will remain real rates, something that we have not experienced for a long time. The central banks are running out of stimulus options, and they need to keep their powder dry, as getting inflation down to target levels and holding it there is going to take a considerable effort. To this, I noted that the labor shortages and the cost effects of climate change are just a few of the inflationary pressures that will most likely continue to challenge the central bankers. This notwithstanding the uncertainty caused by geopolitical tensions. In addition, excessive spending and the growing public debt, coupled with the attendant higher cost of borrowing, is going to force governments to implement unpopular and painful structural reforms, as there's just too much unsustainable spending. Just last week, Jamie Dimon, the CEO of JP Morgan, addressed the risks and uncertainty and described the position more explicitly. And I quote, "They are spending like drunken sailors." However, it's heartening to see the current, and I emphasize the current Greek government, yes, of all countries, which was a basket case just a few years ago and probably still is making steady, albeit slow progress on this matter without collapsing the economy further, that is. That is, of course, if they can stay in power. It can and must be done, and no, I'm not just referring to South Africa. So how do you manage your investments in this increasing uncertain environment? It's not too complex. Look for real earnings growth with good visibility, or should that be a modicum of certainty? This, together with the dose of patience, as the market is currently not paying much attention to these types of options. So where and how does the global property universe contribute to addressing this scenario? For starters, I want to highlight the major variations in the composition of the global property asset class that have occurred in less than 5 years. Now, the changes I want to feature would have been even more glaring had we extracted this table going back 10 years. Have a look at the problematic office sector, which has plummeted from 10% to 5% of the global capitalization of listed property. To this, I just must put a proviso. The media often talks about the commercial real estate. What they are, in fact, addressing is the unlisted property sector, where offices make up almost 40% of the capitalization in the US. However, we as active managers have still steered well clear of this downward spiral for a long time now. Further, the industrial sector, which I prefer to call logistics, continues to eat the breakfast of the bricks and mortar retail sector, with a 6% increase versus a 4% decline in the global market capitalization. This evolution is set to continue as more and more property sectors emerge. That is, so long as it is fixed, tangible, and generates revenue through rental contracts, thereby creating more opportunities for active managers like ourselves. Early on, I alluded to earnings growth. That, of course, being real earnings growth, is the solution to investing in the near term at least. Looking at the left of the chart and starting with logistics or industrial, up to self-storage on the right, you can see that we expect close to or more than 5% growth this year rolling into the next 5 years. There should be no doubt in your mind where our portfolio is positioned. Taking this further, let's have a look at the sector returns. And so what has been delivered to date in 2023, where financing has been a major driver of intra-sector return dispersion. It has been and will continue to be the perceived balance sheet safety and the access to competitive financing, which were and are the key drivers to performance. Let's have a look at a little bit more detail on this performance divergence on a year-to-date basis. That is to the end of the second quarter this year. There's been a noticeable pickup from a limited dispersion in 2022. And I must point out, inter-sector differentials favor stock picking. And just for example, in the residential sector, the differential was 42% between the top and bottom performer. And of course, the office sector is an extraordinary 65%. I mentioned the strength of the balance sheets. And let's have a look at more detail. The European listed property companies are highly leveraged as management has kept borrowing against rising asset values, and the net result is an unpalatable, uncomfortable net debt debt to EBITDA ratio of 12.3. The Asian markets are worth monitoring with less rising rate pressure, given their lower inflation expectations. However, the standouts, to a lesser degree, the UK, which has improved the position considerably, but more particularly the US and Australian companies have applied the hard lessons during the global financial crisis. And as you can see, the US and Australian property companies are exhibiting a net debt EBITDA ratio of less than 5, a very credible position. And this is helping them and helping us project the earnings to the future. The old mantra is changing from location, 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 more to leverage, liquidity, and lending. We then extracted the quarterly year-on-year dividend growth that we've delivered since the second quarter in 2018 and compared it with equivalent G10 inflation rate. You'll see, besides a blip in 2021, we've delivered a substantial outperformance. The main drivers of this position are the seeking of growth at a reasonable price opportunities within geographic and a sector overlay. We also went back and we did some research and what happens when the rate hiking cycle ends. And this almost to a T, REITs have performed remarkably well when rate hiking cycles have ended. And historically, the performance, in particular of the last, for the first 6 months after the last rate, REITs have outperformed equities by a substantial margin. And this continues for up to 18 months before the position gets normalized. However, a risk to our base case is a possibility that the Fed overshoots to err on the side of continuing our more aggressive rate hikes as it seeks to win back credibility amid criticism it was slow to react to inflation. If that would happen, it would push back the end of the rate hiking cycle, and the magnitude of the expected overall economic slowdown could be even worse. So let's have a look at the outlook. It's not all doom and gloom. The valuations of the REITs multiples versus the S&P relative is at the most attractive level since the pandemic and the global financial crisis, with an outperformance that is relative to the remainder of the S&P 500 for the subsequent 18 months after each of these periods being a historic phenomenon. The current average global net asset value discount is 15%, and coming with an attractive forward yield of 4.4%. From a fundamentals perspective, supply is expected to remain below the long-term average given uncertainty and rising funding costs. But our mantra, the balance sheets of our portfolio holdings are in great shape. Finally, on growth, we see resilient earnings growth of 5%. And I conclude by noting that the REIT earnings growth is more stable and predictive relative to most of the other S&P 500 sectors due to contractual leases, high operating margins, and a limited supply. Thank you.
Greg, thank you very much for that. Insightful indeed. And like I said in my introduction to you as well, perhaps a very good time to look at global property again, if you do think that we are towards the end of a rate hiking cycle. Greg, thank you very much. The REIT Global Property Fund available obviously on massive platforms. You all know Greg extremely well. If you have more questions or want to have a discussion on global property, please let us know. We'll get you in touch with Greg. Greg, thank you so much.
Pleasure.
Right, we're moving over again to global equity. And standing by, joining us now is Richard Pitt from Blue Alpha, multi-Raging Bull Award winner. Richard, I'll show that in there. You've been almost like family from the word go. We all know your funds extremely well and looking forward to how you see the world, what you're doing in your fund at the moment.
Great. Thank you, Eugene. And thanks everyone for attending today.
Yeah.
So I must be finished
Richard.
in 2 minutes. Can you hear me?
Yes, I can hear you fine.
Yeah.
I just want to check,
Yeah.
are you going to share slides from your side, Richard?
Yeah, I'm going to
Yes.
share. So I must do my presentation in 2 minutes. Is that right?
No, you've got your 15 minutes there. Yeah, I can see your presentation, and then it's going to full screen mode. Coming through. Well, it was coming through. Now it's back
How's
to. Yeah, perfect. Got it.
Okay, great. So I thought I would also try and do something a little bit different. I see Sean did a little bit something different earlier. Old friend and dear colleague of mine. And Sean certainly made it clear to me that I will never be able to own property in Belgravia. But, you know, we often get asked for our market view, how we think the next 12 months are going to pan out, and kind of reminds me of my days many years ago as a hedge fund manager, and markets were pretty buoyant, and the hardest thing to do was to find a name for your hedge fund. Making returns was quite easy, and I think that's kind of what I feel when we have these little conferences, and everyone wants to know, well, what's the next thing that's going to happen. So I thought I'd change it up a bit and say, I want to talk about principles versus prediction, because I think making predictions is kind of pointless. And I want to just highlight a few basic ideas that I think are important in the investment process for allocators when they choose managers. But before I do that, I'll just start off with some of the usual concerns, or as I've called them, the usual suspects. For those of you who've watched the movie, a brief summary is it was expertly shot and edited. It gives the audience a simple plot and then piles on layers of deceit, twists, and violence before pulling out the rug from underneath. And I thought, if that wasn't a great description of the stock market, nothing is. But there's no need for me to go through all these items. I think they kind of, self-evident. But just to touch on perhaps one or two, if we think about the markets and how the correlation to central bank liquidity and central bank balance sheets is broken down, that's obviously room for concern. And then in terms of yields and equity valuations, which are also showing quite a strong correlation, we've seen perhaps a 300 basis point increase in yields, and valuations have more or less gone back to where they were when yields were a lot lower. So the result of this is that we have an equity risk premium, which is probably sitting at its lowest point in 2 decades. And clearly that is kind of room for concern going forward. And then all the obvious points, we've got China, whether it be Evergrande or Country Garden, obviously likely lots of overinvestment in property, potential debt issues, and lots of concerns about that economy and how it may affect global economies going forward. I think on the positives, maybe the key point I want to just make is that we talk about the stock market versus a market of stocks. And as fund managers, we must be digging for the stocks in the market as opposed to the stock market. And I think later I'll talk to one of our investments, but we see within our portfolios a clear pattern where on the one hand, stock markets simplistically look quite expensive, but there are many examples of high quality businesses, and that's our kind of approach, that are trading at very, very modest valuations. So principle number one, avoid predictions. I think if we've learned anything in the last 5 years, it's that we should expect to be surprised. And I think that first quote by Keynes sums it up very, very clearly. And then related to that, I think it's important as a fund manager, and when you interact with your fund managers, to pick up some humility in them. It's very dangerous to bang down a path which with conscientious ignorance or stupidity. And equally, I love the quote by Hugh Henry, who talks about the arrogance and conceit of a well-formed argument. And Hugh Henry, for those of you who are not familiar with him, ran a fairly successful hedge fund business for many years called Eclectica. And I guess the name says it all. He was trying to generate eclectic returns, and his thinking was quite eclectic. But he talks about this idea of getting so caught up in your thesis and your investment idea that you are unable to actually respond to what's going on in the world around you. And investments is I think, largely a response business as opposed to a prediction business. So how do we make sense of all this uncertainty and the fact that we can't predict? So very, very simplistically, we know there are three basic responses. You buy cheap assets, and cheap makes perfect sense. You can't predict the future, so you buy something at a discount to its apparent value, and you hope in time it will revert to some normal valuation, and that's how you make your money. Another group look for growth, and indeed, if you look back over 10 years or 20, 30, and list, say in the S&P 500, the top returning companies, by far and large, what you will see is that these companies have all managed to grow their earnings, and they've grown their earnings considerably. So there is no doubt that earnings growth is a very, very important component of return. The problem, of course, is it is quite tricky to figure out who's going to grow by large amounts ex ante. In other words, beforehand. So often that's only evidence in hindsight. And then the final approach, which is the area where we fish, call it the quality approach, is invest in companies that generate high returns, have strong balance sheets, have good margins, have pricing power, and let's say don't rely on the kindness of strangers for their survival. So those are kind of very simplistic approaches, and I think in each of those categories there are excellent managers, and I think there's enough sun for everyone, and there's enough space for different styles. Now on the right, what I'm showing is I've actually just bastardized a chart that we use in our own presentations, and I've said this is kind of like the Goldilocks of investing. If quality is good and growth is good and cheap is good, then let's just find that magic intersection and invest there. And surely that's going to be the place to make money. And I would urge allocators to be very cautious and suspicious of such a theory. I think what you tend to find is that the best returns in quality come from the best quality. The best returns in growth come from the high-flying growth companies. And likewise with cheap stocks, I think the returns come from the outliers. And when you try and overlay these things on top of each other, what you tend to do is actually negate the underlying feature or characteristic of each investment methodology. So first principle, investing is simple but hard. We talk a lot about value, all of us in the investment world. And normally when we talk about value, we immediately jump to PE multiples, price to book, price to cash flow, anything like that. These static point-in-time measures. Now, a point-in-time measure, by definition, can tell you nothing about the value of a business. That much should be self-evident to everyone. The value of a business can only be the present value of its cash flows. And its cash flows are determined only by two things: the quality of the business, the returns that it makes over its cost of capital, and the growth opportunities that it has to reinvest in its own business. That's what drives cash flows. And opportunity or valuation opportunities are simply when you get an opportunity in the market to buy at a discount to that value. So the principle is very, very simple. The reality, of course, is very hard. Quality is fairly observable. Growth is much harder to understand. But nonetheless, the three questions: does the company generate good returns? Can it grow? What do I have to pay? I think if you applied this to every single investment idea, it would get you a long way down the road of making good investments. So when we talk about the concept of value, we talk about valuation. From our perspective, this cannot be considered without thought to both quality and growth. So these things are totally aligned and connected at the hip. And apologies to people who may have seen this chart before, because we show it frequently. We keep banging down this point. And here we show a very simple example of two companies which have the same accounting earnings, it could be the same cash earnings for that matter, but have different operating assets. So company B has twice the operating assets of A, and as a result has half the return on invested capital. And if we assume that the cost of capital is the same for the purposes of this argument, we can quickly show that the real economic profit, which is the return above the cost of capital multiplied against your operating assets, is positive for A and negative for B. And the next step is to say, well, what is the value of those cash flows? And we just discount that by the cost of capital. And we can say, okay, the value of the business is the operating assets, the book value, plus the future value of the real operating profits. And in this case, what happens is we get to a valuation of 800 for both companies, 1.6 times book for company A, and a 20% discount for book for B. And both these companies will have an 8 PE. So on a price to book basis, B will look cheaper, the PE multiples will look the same. They are very, very different businesses. What should be happening with B is it should be shrinking its business. It shouldn't stay in business. And indeed, if company A can grow its business with these returns, it increases the value even more so. And that's what we're showing in the second part of this equation. When you add the growth component, the enterprise value goes up enormously because your future cash flows go up. And the justifiable PE in this basis mathematically would be 20 times versus company B. It actually has no value because you are reinvesting into a negative return, negative real return, if you will. So our point is just be careful of shortcuts. And also that's why for us, the return on invested capital and quality is so important. The next point is what happens if you don't invest in quality? And this is a chart of the share price of International Paper in gold or orange versus the S&P, and it goes back 30 years. And International Paper, as you will all know, is the largest global paper and pulp business in the world. Interestingly enough, it was founded at the turn of the 19th century, so it's been in business for a very, very long time. And the reason I put this chart up, and this doesn't include dividends, but if you include dividends for both, the chart is not vastly different. The relative return is quite similar. It's about 9 times difference. About 20 years ago, I was reading an article 20 years ago. The writer was having a meeting with one of the long-time executives of International Paper, and he very frankly admitted that over the past 2 decades, they'd only beaten their cost of capital twice. So the point is, low return, bad businesses don't automatically go out of business. I think South African gold companies are an example of that. There's always ways to raise more money from shareholders, take on debt or do something, but they tend to persist. But over long periods of time, they destroy value. We talk about reversion to the mean as if it is an absolute fact, like gravity, death, taxes, and reversion to the mean is a report that I saw the other day. And here we're just showing in this chart, when we talk about returns on businesses, reversion to mean is not as obvious as we think it to be. And there's various analysis which shows this. This is a recent research paper going back 30 years, looking over 3-year periods. And basically what it says, if you broke the market up, this is the Russell 3000 into high return quintiles down to low return quintiles, almost 50% of the companies that were in the top return quintile are still there 3 years later through this whole exercise period. And equally, 40% that were the worst return businesses were there 3 years later. So that speaks to a lot of stickiness or persistence in the underlying returns of businesses. And then just to say as well, if you look at transitions, worst to best there, and then top right, best to worst, those are relatively low percentages and generally speak to super cyclical companies. Another point I want to make, with apologies maybe to Chen, is don't be too distracted by the macro. This is a chart of China versus the S&P going back to 2000. And I think China really became topical on investors' minds in the early 2000s. And I'm sure most of the investments were probably made around this time. And had you known in 2000 that Chinese GDP was going to grow, per capita GDP was going to grow 10 times over this period, 5 times more than in the US, that its economy was going to grow from the 6th position in the world to the 2nd position, from 12% of the US economy to over 70%. I think it would have been very hard to imagine that this would have been the outcome in the stock market. Now, we know there are lots of issues in China, youth unemployment, debt issues, but the point remains, macro doesn't necessarily give you a good indication as to the prospective returns. And then again, be careful of simple ideas. Here we're showing the Fed funds rate. As we know, it started going up in March of 2022. And as the Fed funds rate went up, one of the very simple themes or stories out there was this was the time for value over growth. The logic is self-evident. Well, it was self-evident at the time. Growth stocks, earnings are far out, they have longer duration. And so as the discount rate goes up, their valuations must compress more. And indeed, this appeared to be working for, sort of part of this period. And as we all know, this has kind of fallen over recently. So I think these simple ideas grab you and they seem to make sense, but one needs to be very, very cautious about this kind of thing. And then just another spin on a simple idea, Europe versus the US. This chart, courtesy of Goldman Sachs, just shows the ratio of capex, of growth capex and research and development spend to cash from operations. And you can see that in the US, it's about double. We split, here they split up US tech and US ex-tech, but it's about double Europe. And if you think about it, that's what generates future returns, investment in businesses going forward. And obviously investments over your cost of capital. So this is the kind of business that we like. Ulta Beauty, beautiful company, very simple, provides beauty, hair care products, makeup, that kind of thing. In the US, it has 1,300 stores across 50 states. It's a very high return business, as you can see on the chart on the left. And its rating has been coming down quite significantly through time. So the company has a long history of allocating capital intelligently. It buys back shares with its excess cash. It doesn't have much debt. We think it's a really excellent business. And on the right-hand side, we're showing the earnings relative in blue, which you can see is kind of been going flat. So that's earnings versus the market, and the price relative. So essentially what we're saying is that it's gone through a huge derating. And we think, for a business of this kind of quality, it's really not justified. And the reason why I mention this in our portfolio has got lots of these types of companies. The differential between this company, clearly it's at a discount to the market, but year to date, it's about a 30% return differential versus the S&P. So clearly those things, would weigh on our short-term performance, but we think that the inherent quality of underlying investments is very, very attractive. Just quickly, this is our performance, since inception, which was September 2014. We've done very well, beating the world index, which is harder than what anyone will tell you, and well ahead of the global equity general average. More recently, struggled a bit in terms of relative performance, but a lot of it is, because of investments like Ulta Beauty, really good companies. If we unpack our performance versus quality, which is our chosen approach, we show through time. The blue line is our fund, and the gold line is the Morgan Stanley US Quality Index. And as you can see, that broadly has been going up through time. This period, sort of coming out of COVID, we gave up a lot of ground simply because I think we were just too cautious, and we kind of, stepped away from some of the really good businesses that we thought valuations were just a bit too much. So, in hindsight, that was an error. So just to conclude, I think it's very important not to make predictions and don't get caught up in grand theories. Just, try and do what makes sense. I think for allocators, you must diversify approaches, and not necessarily on style, but along, when you talk to different managers, you'll pick up differences in approach, rather than just boxing them in a style category. And it's interesting, I know some of the people on the webinar, some of the managers, and as I said, I worked with Sean Pesce for a long time. And when I pulled out a couple of their funds, it was interesting to see that actually over time our returns are quite similar. The way we got there was quite different. So if you blend the right managers together, I think you can get a really good outcome. And then finally, there's that old joke where someone said to, I think it was Johan Rupert, they said, but you only do business with friends. And he said, sure. I mean, you must do business with people that you like and trust. So I think that's also very important. Choose managers that are open, that you like and trust, and that you can have a good dialogue with. Thank you.
Thanks, Richard. Thank you so much for that. Very insightful indeed, and it speaks to the old story. Make sure you have a good quality manager, right? And a manager you can trust. Richard, thank you so much for that. For the audience out there, you are very familiar with Richard. They also have an open door policy. If you need to know more about the Blue Alpha Global Equity Fund, they also have a worldwide flexible mandate they manage. More than welcome to get hold of us, and we'll give you some more details on the funds. Richard, thank you. We hope to speak to you again in the very near future. To our audience, we are going to move on. We're still staying with global equity, and perhaps picking up on the lines that Richard spoke about now. Is it about global growth or global value? Our next manager often say that they manage assets at the intersection of growth and value. Joining us now all the way from London is Jared Khan from Credo Wealth. Jared, thank you so much for joining us on our session today. We're looking forward to your presentation.
Thank you very much, Eugene. It's great to be here today. Just to correct you, we operate at the intersection of quality and value, definitely not growth and value. But thank you anyway for a very warm welcome. So if you can just move on to the next slide and we can get going. Richard made a very interesting comment about, sometimes the simple things don't actually work out the way they're going to be. And if I was sitting at the beginning of the year thinking, what's the worry in terms of our strategy, what could hurt us? And it was probably going to be the pivot trade, the fact that interest rates around the globe was going to start coming down and growth was going to have a significant rally. And interestingly, what has happened is growth has had a significant rally, yet interest rates have gone even higher. So it just goes to figure that you can't actually plan your portfolio according to certain macro events. But just to put it all into perspective, it's been a really tough year, not only for value and quality investors. I think it's been a difficult year for most investors, and I'll get into why that is the case. I think we have a very unique situation. It does happen from time to time where a very narrow rally in a few stocks just leads the market much further. And unless you're really playing in those stocks, I think you get left behind. But just taking it back again, this is the relationship between growth and value through 50 years. We've seen in the tech rally of 1998 to 2000, we had a significant outperformance of growth versus value. And then again, during the global pandemic, an even bigger outperformance of growth versus value. And then, in 2022, we see interest rates start moving up, and all the long duration assets and high PE multiple assets get crushed a little bit in 2022. And everyone thinks, well, this is the time for value again. And yet we sit here in 2023 and value has quite significantly underperformed growth. You can just move to the next slide. So yeah, year to date, if we look at the MSCI value index versus the MSCI growth index, MSCI growth is up 27, nearly 30% year to date. MSCI value is only up 3.3%. So again, big jaws, a big opening up there, and great performance out of growth and pedestrian performance out of value. Next slide, please. So the question that needs to be asked is where does this come from? The differentiation of returns, is it coming out of earnings growth? Are these growth companies really shooting the lights out in terms of increasing the earnings per share, or is it something else? And I think something that's quite interesting here is if you look at it, it's all actually come out of price to earnings ratio movements. In terms of the growth index, you look at the beginning of the year, the PE on growth was about 20 times. It's now somewhere around 25 times. So the re-rating is about nearly 30%. Whereas if you look at it in terms of the growth index, the value index, it's pedestrian. It actually hasn't even moved the dial. So that's something to be concerned about. When you have re-rating in these stocks, the question is, when you get multiple decompression like we saw in 2022, stocks come down much quicker than they go up, and you just need to be wary of it, and you need to be in a position where you are, have this various risk measures in place to take action if that does start happening. If we can move to the next slide, please. But something else has happened this year, and I've kind of touched on it a little bit, but it's this huge bifurcation of performance between mega cap stocks versus the rest of the market. And although we talk about the Magnificent Seven, I'll get onto them in the next few slides, an easier way to look at it and a more simplistic way to look at it is just looking at the S&P 500 weighting as it is today. So you have the market capitalized weighting, and so obviously the mega caps are a much heavier weighting than the other companies versus the S&P equal weighted index. And year to date, although the year started very much in the same vein, between December and February, performance was quite good. And then in March, I think the first dislocation happened when we had the mini financial crisis in the US. And then subsequent to that, you've had this big divergence in returns between the equal weighted and the ordinary index of about 12%, which in the context of indices is actually quite significant. And again, one needs to question where this comes from. And again, if we just move to the next slide, you can see that this is actually all coming from re-rating. The S&P mega caps have re-rated quite significantly versus the equal weighted index. So again, if we just move to the next slide. So where is this coming from? Who's to blame, or who's creating, this mega upside that we've seen in the market? And Jim Cramer always comes up with some lovely little phrases. And we now have the Dow Magnificent Seven. It used to be the FANGs. It used to be the Nifty 50. We have all these names, but the Magnificent Seven are the cause of this huge rally in the S&P 500. And the stocks, we know them well: Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, and Alphabet. And again, if you just move to the next slide, we really kind of see the significance of the outperformance of these stocks relative to the 500 or the 493 other stocks in the S&P index. I generally show this slide because I think it's very graphic. It kind of puts everything into context. So if you look at the lime green, first of all, you identify the 7 stocks: Microsoft, Apple, Nvidia, Google, Meta, Amazon, and Tesla. You can see that they're all up over 20% year to date. The darker green, companies like JP Morgan or Home Depot, are only up by coding a maximum of 15%. So all of the lime green stocks are over 20% year to date, but the performance has been spectacular. When you look at Nvidia, up 230 odd percent, Meta up 150%, Tesla, this was taken before the 10% jump earlier this week, so that's up over 100% year to date. And again, I've alluded to this in previous presentations, the size of some of these companies. If you look at Apple, a one-day price movement in Apple is equivalent to basically all of the credit services and diversified banks in the financial sector. So you take Visa, JP Morgan, Bank of America, Wells Fargo, Citi, Berkshire, American Express, MasterCard, PayPal, you get the picture. Combine all of those stocks together, one price movement in Apple is equivalent to those stocks. So these are behemoth companies. And the truth is, if you didn't own them, you're not going to have performed in line with the market. And on top of that, if you had some of the other stocks that didn't perform well year to date, so some of the defensive sectors, like in the healthcare, some of the banks, some of the industrials, obviously energy, mining, things like that, that's going to detract from your performance. So it's been a very, very difficult market for investment managers. Can I have the next slide, please? So what has changed? And I think, we talk about the mini crisis in March that kind of put a ceiling, I think, on interest rates. But more importantly, since then, we've had this new idea of artificial intelligence, the launch of ChatGPT, and the fact that the market believes that these 7 stocks, the Magnificent Seven, have such a new kind of advantage over the rest of the market in terms of being so far forward, and the fact that they can take this technology to new levels where the competition or the moat will be significant and give them significant profitability going forward. Next slide, please. So another interesting slide that I pulled up was when you look at periods of where stocks or a very concentrated amount of stocks dominate the market. And we've taken this back to the early 70s. And what you elude from the slide is the top 10 holdings that make up over a percentage of the overall index. So in the case of the US blue chips in 1977, those top 10 stocks, IBM, etc., made up just over 20 to 23% of the index. And you have to go a long way back, in other words, to 1977, to the period to where we are today, where we have the new thing, the onset of AI, where the Magnificent Seven and 2 other stocks, basically Berkshire, Exxon, and are making up the position. And interestingly, what you have there in Berkshire, if you look at the listed holdings of Berkshire, about 50% of that is actually Apple itself. So effectively, you have all of these technology companies, very concentrated, making up 20% of the index. But the other interesting thing to note from this graphic is that if you look at the rolling return of those stocks over the next 5 years, there always seems to be a disintermediation. They can never hold those positions and actually start giving up some of their performance. So thematically, the other periods, if you look at the major global majors in early 80s, we had huge inflation or Japanese financials towards 1989, and even the tech bubble in 2000, where the concentration was about 16-17%. None of those stocks that generated the top 10 of those times actually remained market leaders. And fascinatingly, if you look at the 20-year period that we've been in since the tech bubble, there's only one company that's actually maintained its position in the top 10, and that's Microsoft. The other one arguably is Exxon, but it did merge with Mobil. So it's a slightly different entity to what it is today. So I think it just, again, kind of rings some warning bells in terms of it's one thing being in a certain sector, it's one thing being in a certain theme, and maybe these companies do have some competitive advantage in the short term, but trees can't keep growing to the sky. These companies are very, very large, and the question is, at what stage do they start giving up some of that performance, and some of the other 493 other companies in the index actually start catching up? And as asset allocators and stock pickers, one needs to be a bit wary of this kind of phenomena that's taken place. Next slide, please. And again, just to kind of move on to the topic and to try and explain how this kind of bifurcation of performance is unsustainable, we look at periods of time going back from 1989 to December 2022, where the S&P index and the S&P equal weight, over that period, there's very little difference, 11 basis points per annum. And over the last decade, it's even smaller. The S&P was up 12.5%, 12.53. The S&P equal weight was up 12.51. So almost no difference in returns. Next slide. So what is interesting, again, is if you look at periods where there are significant dislocation, and there haven't been many, but I think two very good examples are 1998, 1999, where you had the 2000s tech bubble. The S&P 500 index was up 30.5%. The equal weighted was up 11.44, so an outperformance there of 19%. And that actually continued in 1999. So it can continue for over a year or two. It's not this 1 year phenomena where the S&P outperformed by 11%. But then, as always happens, you get some kind of mean reversion. In 2000, the bursting of the bubble, where underperformance of the mega cap tech names by 17%, and again a follow through the following year by another 10%. And then in COVID, maybe not as illustrative, but still quite significant. In 2020, you have outperformance of the S&P 500. 2021, it's pretty flat. And then you have, as I said, this mean reversion in 2022, where the mega cap growthy kind of tech names underperformed the broader base market by 7%. But interestingly, where we sit today, and this is where I think people need to be quite alert, on an annualized basis, the S&P index is outperforming by about 18%. It is in real terms only 12, but if you take it to the end of the year, it's approximately 18. So you could see another period of time where, the next year it continues outperforming and you get an even bigger kind of variance. But ultimately, these things do revert, and you just need to be cognizant of it. If we can move to the next slide. So what do we do as fund managers? I think, we stick to our guns. We continue doing what we do. And this is moving away from kind of first level thinking, not looking at the short-term noise, not looking, at the hype, the thematic kind of movements. It's all about AI. You've got to be in the sector. You've got to buy these stocks. In fact, you need to be obviously far more second level in your thinking. You need to look at the risk reward imbalances between expectation, worst and best case scenarios. You look at the pricing of these stocks, and you need to understand whether you think that the kind of moat that these companies are perceived to have is sustainable, and where things can go wrong. And ultimately, you need to take a longer term view, and you need to stick to your guns. And we tend to like to continue, having diversified portfolios. We don't necessarily understand technology. I think disintermediation in technology is a tricky thing. Things move very quickly. And for that reason, it's not a sector that we believe longer term you can be comfortable putting away for 15 years. So we own companies like HCA, Progressive, Flutter. And interestingly, we have actually bought Alphabet in the last few months. If we can move to the next slide, please. So you would have seen this slide in previous presentations that I've had before, and it's just, again, putting you into perspective of the type of fund that the Credo Global Equity Fund actually is. We are very highly correlated to value. We're yin and yang with value. So if you look at the dark blue slide, that is the MSCI Value Index. If you look at Credo, which is in the middle, as value goes down, we go down. As value goes up, we go up. Yet, because we have this qualitative overlay, we've managed to outperform the value index quite handsomely over a considerable period of time. And again, we have a negative correlation to growth. So the gray line being the growth index, as that's moved up, we've moved down. The dotted line is the MSCI World, which is our benchmark. And we've actually performed pretty well relative to the MSCI, given that there has been such a growth bias over the last decade. While we've been running, the fund, particularly over the last 5-6 years. We can move to the next slide. Again, just a reiteration of the kind of philosophy we have and the valuation of the stocks we have in our portfolio. So the blue line, the Credo Global Equity Fund, has a PE of about 13.6 times versus the benchmark of 18.2. So significant discount our index, not dissimilar to the MSCI value, and significantly different to the growth index. So we feel that our characteristics, as we say, are very much more in line with value, with that qualitative overlay. Next slide, please. And again, I think just to wrap up, where are we positioned right now? How are we thinking of life? It's been a tricky year, as I say, not only for value investors. I think it's been a difficult year for most fund managers. It's been very difficult to outperform this index, particularly when you have such a narrow band of stocks that are leading the rally. If you recall, and you followed the fund, going into 2023, we were overweight financials. We were at about 33% at one stage. That's been brought down to about 25% now. But interestingly, when you talk about financials, we're not talking about banks. We're talking about a broad-based spectrum of financial stocks, which include things like auto insurers. In the top 10, we have Progressive Group, we have Admiral, which is a UK auto insurer. We have specialist financial companies like exchanges, Chicago Mercantile Exchange, IG. We have pure, prop kind of insurance companies like Chubb. So it's pretty well diversified. We remain underweight information technology or tech stocks, as you would know, but we do continue to hold Microsoft in our holdings. And we've actually reduced our exposure to Microsoft somewhat, and we've introduced Alphabet into the portfolio, which comes under communication services, but in my mind is a technology company. And we took the opportunity to add Alphabet at the time when the stock fell out of favor, when ChatGPT came in, and everyone thought that they were going to lose their marketplace in search. And we think actually it's very well positioned right now, and the valuation looks quite good relative to the rest of the sector. We remain overweight healthcare. We continue to own companies like Cigna Health, HCA, Humana. We are relatively equal weight in energy. We've done quite nicely over the last few weeks on Shell and BP. And we like to remain diversified in the portfolio and not try and take any one specific bet on any theme. Likewise, geographically, although it looks like we're underweight the US with only 56% and overweight the UK at 23%. Most of the UK stocks that we hold are actually multinationals who make most of their money actually in the US. So I think it's relatively unhelpful. But just in conclusion, just to say, where we're thinking right now, it's been a pretty interesting time, I say, given what's happened with the Magnificent Seven, where the market is right now. Whether it's sustainable, I don't think it is in the longer term, but certainly it could continue with the momentum over the foreseeable future. But ultimately, you need to be in a portfolio that's well diversified. You need to be in great quality businesses that are valued well. And we believe that the portfolio we're in hits all of those buttons. And I think as time changes and as sentiment changes and momentum shifts, you start seeing the benefit and the advantage of having a very high active shared portfolio and not being, clung to the mercies of these seven stocks. And that's the wrap from me.
Jared, thank you so much for that. Very insightful indeed. Just a very quick question. I mean, if you look at US equity markets at the moment relative to bonds, US equity does appear to be very, very expensive. Richard, before you made the comment before, and we've heard this many times, that PE ratio is a bit of a blunt tool to get a true sense of valuations of companies. But rather, what is the prospects of decent growth in earnings going forward on some of those companies that you hold, as opposed to just looking at price?
Yeah, that's quite a complicated question to answer, but essentially the way we look at things is you need to look at a company individually. You look at its earning growth relative to its PE, but I guess simultaneously you need to look at the earnings of those companies relative to where you are in the market. So as you say, the S&P is expensive right now. So would you buy the average earnings per share growth from the S&P? I think it's at around 8% per annum when the actual index is trading on 18 times. And the answer is that doesn't look too attractive to us. The type of companies we do buy are, in mid-teen to high-teen kind of earnings per share growth, trading in mid to high teen kind of multiples. So we think the risk reward payoff on those kind of stocks is much better than just buying the index. And that's, that goes down to stock picking and digging through the weeds and trying to work out, what you've got.
Jared, thank you so much for that. Very insightful indeed. The BCI Credo Global Equity Fund on mostly all the platforms. They've got local representation here as well. For those of you in Durban tomorrow, you'll actually meet one of the Credo team members there as well. Jared, thank you so much. We look forward to speaking to you in the near future.
Thank you. Cheers.
Right. We're moving on to our next topic of the day, passive investing. What is that all about? And can it capture some of the momentum in the market at the moment? Joining us now is Anthony Ginsberg, founder and CIO of Ginsberg Global, running index fund as well. Anthony, thank you so much for joining us today. I believe you're in Los Angeles.
Hi, greetings. Good morning from California. Thanks, Eugene, for your support.
Fantastic. Looking forward to your presentation. You can start when you're ready, sir.
Yes, well, we have a US presidential election coming up here. I know the elephant in the room, I was listening to Jared, is all about, is the US market overvalued? Just to say that the S&P is almost 8% off its 2021 highs, and the NASDAQ's about 15% off its 2021 highs. So I'll get to that in a few moments. Indexing by its very nature, 2 points I want to raise is, why are there trillions of dollars moving over the last decade and a half, almost 2 decades, into indexing? This has actually been a 40-year phenomenon. Of the 5 largest asset management firms globally, many of you know 3 of them are index firms. We've, for the last 23 years, partnered with State Street, which is one of the top 3 players. We don't have to worry about, particular styles, whether it's growth versus value, and we see it as a prudent approach. Essentially, we're not saying we're going to always beat every active manager out there, but typically indexing does beat close to 85 to 90% of most active managers. So it may not make me popular on this call, but the truth is, if one calls a spade, there are only about 10 to 15% of active fund managers that consistently can actually outperform the index. So trying to find the needle in a haystack is really a tough story. And really, this myth of being a stock picker's market, whether it's a bull market, a bear market, indexing consistently beats, let's say, 85% of US fund managers. I'm going to get to a couple of slides to show you just why there are these trillions of dollars using this prudent approach, particularly amongst US institutional fund managers, pension funds here, endowments, insurance companies. Certainly in Europe and in the US, there's been a big trend towards collaboratively using active and passive together. So we're not saying it's all or nothing. We see it as a blended approach. And let's go through some of the next slides where you'll see indexing is really a core approach. It's typically anywhere between 25 to often 40% of portfolios. So if you look in the US, since 2000, in the blue line, the passive has had massive inflows. This is indexing as a core benchmark approach. It's seen as the broadest way of investing. Essentially, typically you've got 10 to 20 times as many stocks in an index fund. By its very nature, something like the S&P 500 obviously has got 500 stocks. The MSCI World has got 1,600 plus stocks. And most of the active fund managers are typically less than 100 stocks, often less than 50 stocks in their holdings. And often their top 5 to 10 will make up a sizable weighting. So here you see passive hitting almost $6 trillion of flows over this period of time versus active really going in the opposite direction. And this is partly because certainly in industrialized markets, it's incredibly difficult now with thousands of stock market analysts and portfolio managers all trying to analyze and be ahead of the game. It's incredibly difficult. Years ago, 30, 40 years ago, perhaps on the golf course, it was easier to do certain things, but we all know compliance has become much tougher. Thanks for the next slide as we move along. You'll just see the outflows from active going back a decade or 2 here in the blue line, basically being surpassed and matched by passive flows. And this again relates to the outperformance of passive. The vast majority of US fund managers and also on the MSCI World side, the global fund management, it's been disappointing. It's been very hard for them to consistently blend value and growth and match the performance. We've heard about the Magnificent Seven, but truth be told, it's beyond just the seven. If we go, and we'll look in a few moments at some slides, going back 2 decades, over 20 years, there've been a huge number of active funds that have had to close down. 70% of US funds, active funds, have closed over the last 20 years. I'll get to that in a moment. Thanks, Eugene. We'll just go to the next couple of slides. This shows globally that almost 40% of global assets are now passively managed along index lines. Could be in ETFs or in index funds. So this is part of the global trend, and these are very smart pension funds, insurance companies, banks, who've essentially said for their large cap pieces, for their developed world exposure, MSCI World is really a prudent approach. And that's what we've done with BCI. We really are very appreciative of the BCI community and your support. We're almost at R1 billion, fast approaching, just in over a year since launching the MSCI World BCI Global Equity Feeder. Thanks. We'll go to the next one. This just again shows the trillions of dollars and the passive attack, we call it, of indexing, both in mutual fund structures and ETFs over the last 2 decades. So this is showing in trillions of dollars a total, if you add it all together, the ETFs and the indexing basic index funds, 15 trillion in total. So there's been a huge trend in this direction globally. Many of the larger players essentially are blending both active and passive. They're not taking one versus the other. And that's the way we foresee it. We're not here to be unpopular with active fund managers. Many of them are my good friends and some very, very smart cookies. I think some of us studied business science together as well at UCT back in the day. So we're not here to disparage anybody. We see it as a blended approach, just as you see on Wall Street and in the City of London. Thanks. We'll move on. This just shows the closure rate of funds in the US in particular over 20 years in the gray. It may look blue on your screen, but in the gray you'll see over 15 to 20 years, close to 70% of mostly the underperforming funds, the ones in orange, tend to disappear. So if you go from the 1 year on the left-hand side of the bar chart to the right-hand side, you'll see essentially all the underperforming guys. A lot of them tend to get merged or closed out of existence, and typically only the outperforming active funds remain. So you'll see the active funds that have outperformed are a small slither. They're under 20%, but there you go, they're in green. So the chances are of picking the hotshot fund managers who will consistently outperform and be there 20 years from now is quite small when you look at a chart like this from the States. Thanks, Eugene. Go on to the next one. This just shows the different parts of the S&P 500 broken up. The first line is the entire S&P 1500, which is a broader base, and then the S&P 500 is the second line. But over 10 years, which we've highlighted in the red there, you're looking at basically 90% plus underperformance by US fund managers relative to these large benchmarks, the S&P 500, the S&P 1500, even the mid cap and the small caps have already struggled. That's because it's typically a very efficient market here in the US, and also indexing is incredibly cheap. We're doing it with our feeder fund with BCI, and at around 30 basis points, and we continue to try and bring it down as far as possible. We'll move on. Thank you. Just a few more. Essentially, just to summarize, what we've done with BCI is to have this MSCI World Index at a low cost. It's approaching about R1 billion at the moment. We don't have any grade listing issues, incidentally, because we've been in Mauritius for 2 decades now. They went through a grade listing themselves some years back. All our compliance has been very smooth. So over the last 6 months with South Africa hitting the grade listing now, all our procedures have been in place for some time with all our custodians like State Street. So we've had no issues with the bankers, and we've had no issues about suspending any trades or flows. Typically, people are using us along with active funds, and we've heard recently that, it's been a bit tough for some guys on the SA grade listing. We haven't seen that. State Street at this point is almost $3 trillion in size. We found their index tracking actually in some cases better than Vanguard, because we're accessing institutional portfolios which are hard to come by which are at very, very low cost and tend to not have, they tend to be stickier. We don't have as many trades on a daily basis in and out, which could swing the index tracking error. The key for us is to have an index tracking error of basically under 3 basis points as far as possible. And there is a benefit to have a partner such as State Street, because globally you can reduce your dividend withholding taxes via global tax treaties. So you want a sizable index tracker as part of your setup rather than a small one, because you want to benefit from all these global double tax agreements. Thanks. We'll go to the next slide and just briefly show you from the South African point of view. This is not just to single out South African fund managers. I'll show you some American and European sad stories in some cases as well. Again, reflecting about 90% of fund managers struggling. So this is a global phenomenon. Just in the middle there, under global equity, you'll see over 5 years, SA managers really struggling. 96% of them over 5 years have underperformed. This is essentially an MSCI World comparison. We're using the S&P data, which is a very similar index. And yeah, it's been very, very tough. Again, as we know, this market at the moment has been somewhat beaten up in terms of maybe last year value looked really good. This year growth looks good. We're not in the timing game. So for indexing, it's quite easy, relatively speaking, because we've got some of the larger caps that are, you know, Apple, for example, at the moment is about 3.5% of the MSCI World Index, and everything else goes down from there. So it's a very, very broad, prudent, diversified way of investing at low cost. Thanks. We'll just move on to a few more slides. I'm happy to take any questions. This briefly under global equity summarizes South African fund managers over 10 years, 5 years in the purple, and in the yellow over 3 years. Again, it's not a pretty picture. It's been very, very tough because the market, you know, gives 1 year and takes away the next year. So it's been difficult for value or growth guys to sustainably outperform the MSCI World. Just a few more slides. We'll move on to the next one real fast. I think the main point here is that the inconsistency of active, and that's what's drawn the trillions of dollars into passive globally. They've just had a tough time consistently outperforming. So that's why you see something like 70% plus of US funds closing over the past 20 years, and how the market share has moved from active to passive. So here in the States, about half of all flows into mutual funds on an annual basis now are already passive funds, and that's how you land up with, you know, 3 of the biggest 5 asset managers globally, which is basically BlackRock, Vanguard, and our partner State Street, really dominating the business. And indexing really at the end of the day is a core approach. We're not trying to be overly smart or overly clever. We're just saying we're going to buy the MSCI World. It's a low-cost feeder fund. It should be a core building block for many South Africans. No one's going to get fired by using the MSCI World as a blend with 1 or 2 or 3 or 4 well-known active fund managers. So we just keep saying to people, use it as a benchmark against which you can also include your active fund managers. With that, Eugene, I think we have just 1 or 2 more slides. I wanted to address the US fund managers underperforming over 10 years and 20 years and 5 years. Just in yellow, I'm highlighting there on the global side how difficult it's been for the US fund managers. So we look at the S&P globally. There's something called the S&P Global 1200, which they benchmark more often in the States here than MSCI World. And something like 89% of the guys have underperformed. If I could just move to the next slide, you'll see on the domestic American story, it's similar. S&P 500, S&P 400 over 10 years. You've got 80 to 90% of fund managers really struggling here to outperform. And that's led most institutional portfolio managers here just to say they haven't given up on active, but they'll pick a few top active fund managers who've been around for decades, and then they'll blend it again with indexing. Just 1 or 2 last slides. One relates to Europe. You'll see also the same story in the UK and in Europe over 5 years, over 10 years, just the percentage of guys from the fund management side struggling to outperform. It's a similar story. So it's not just a US phenomenon or a South African phenomenon. This is carried right through globally into Europe as well. I believe there are 1 or 2 last slides just to look at the US outlook. Many people have talked about this being a tough market. But if you had bought the index this year in the US, you would be up almost 20% already. There've been a lot of doubters earlier in the year because of US inflation and because of maybe Chairman Powell, who may destroy the economy potentially by raising interest rates. Actually, we have a bit of a Goldilocks scenario. As I mentioned at the start of this presentation, we're still below November 2021 levels on both the S&P and the NASDAQ. On the NASDAQ, we're about 15-16% below late 2021 levels, and on the S&P, we're around 7 to 8% below that. Apple recently came off almost 8.5%, which also means that coming in now, the index is actually a little bit lower than it was. Just to say that in US presidential elections, typically the market, in almost all US presidential election years, which is next year, 2024, they have a very positive experience. Typically, the Fed is very accommodative. We're expecting the Fed to pause next week, which should help growth stocks and some of the well-known tech chaps out there. But more importantly, US job market has remained pretty robust. There's now, according to Goldman Sachs, a 90% likelihood that we don't have a recession and we have a soft landing here in the States. So we remain upbeat. This year, the S&P 500 has actually beaten 67% almost of US fund managers. So the tricky thing is when you go purely active, you could miss the index rally, you can miss the Magnificent Seven, you can miss some of these large cap growth. So again, we're not saying it's all or nothing, it's a blend. And Eugene, thank you for your time, and just wanted to thank the BCI community again for all their support. Again, this is not rocket science. We're saying use indexing as a prudent core approach. It's not going to be the full part of the portfolio, but it's a low-cost core approach. Thank you guys very, very much.
Thank you so much for that. And I think you hit the nail on the head. You know, if this party were to continue for a while longer, you don't really want to miss out on some of those mega caps as well, and overall performance of the MSCI. The Guinness Global Tracker Fund, obviously a low-cost way of getting access or getting exposure to all those companies and all those stocks, and it also helps you to reduce your total TIC for your clients. Anthony, I don't see any questions. Thank you very much for joining us this afternoon. Looking forward to chatting you in the near future.
Cheers. Thank you very much, Eugene.
Right, our last session for the day, and we're running a little bit over time, but definitely not the least. And we're looking at global value again with Contrarius Investment Management. Welcome back, Simon Robenheimer. Really great to have you on our sessions again. We last saw you in May. So great to have you joining us on our online webinar to look at how you see the world and what's happening in your fund, being contrarian while being mindful of earnings cycles.
Brilliant. Well, thank you very much, Gene. It's great to be here. I've only got 15 minutes, so I'm going to spend those 15 minutes to talk only about the shares in our fund. We are to the core stock pickers, and I hope that this presentation reflects that. So I've only got 2 slides, literally. You can skip through all of those. That's the first of my 2 slides. On the left, you can see our top 10 holdings in our global equity fund. Those are also the largest holdings in our global balanced fund, our largest equity holdings. And those are ranked from largest to smallest. In size, they range from 8% for the biggest, which would be Warner Brothers Discovery, down to 3.5% for Baidu. And in total, these 10 shares make up around 53% of our global equity fund. Just a big picture view, about a third, just over a third of our fund is invested in consumer discretionary shares. So those are companies like Tesla, you can see there, Amazon, and the delivery companies like Just Eat and DoorDash. We've got just under 30% of our fund invested in communication shares. So those include the top 2 shares there, which are Warner Brothers Discovery, as well as Paramount, and then a little bit lower down Meta, which of course is the old Facebook. So that's just under 30%. And then we've got a further 17% invested in energy shares. Those are largely the oil drillers like Diamond Offshore, which you can see there, and Seadrill in the top 10. At times, our portfolio has looked a lot more like a traditional value portfolio, i.e. low price to historic earnings or low price to book. And at times, our portfolio have a much more growthier tilt. Currently, I would say it's very much a hybrid. You would note that we have 3 shares in our top 10 that are also included in the MSCI World Growth Index, which is on the right there. We've shown you both the 10 largest shares in the MSCI World Value Index and the 10 largest shares in the MSCI Growth Index. The reason for that overlap with the Growth Index is actually not because we are cognizant of what's in the index. In fact, we pay no attention to that at all. It's purely coincidental. Bear in mind, though, that we are still substantially different to the index. So those top 3 sectors that I mentioned earlier make up 23% of the benchmark index, but make up 80% of our funds. So we are still very, very different despite that overlap. I'll maybe touch firstly on our 2 largest shares, which are Warner Brothers Discovery and Paramount. Now, these are 2 companies that we followed for a very, very long time. Paramount, for example, came about as a merger between a business called CBS and a business called Viacom. And we've owned actually both CBS and Viacom throughout the history. In fact, going back to 2009 when Contreras was founded, we owned CBS. So we followed these companies for a very long time. I'll give you a big picture overview of what's happening. In the past, in the US and I guess elsewhere in the world, TV content was mainly consumed in a linear fashion via cable or satellite TV. Nowadays, more and more people are streaming their content. Why? Well, it's a much better user experience. It's a lot more convenient. You don't have to wait around for your TV show to start. You can watch what you want, when you want, a la carte. What does that mean for these companies? Well, the first thing is that the cable company, which is the middleman, is being cut out, which implies lower system-wide costs for end users. It also means that you don't have to pay for a bundle of channels that most of which you're not interested in. So it lowers your costs to an end consumer. It also means that as a content provider now, you can establish a direct relationship with the end consumer. You're not being disintermediated anymore, so it's a far more valuable business. And you've got a lot more granular information on the profile of your clients, which I think is tremendously valuable to someone like an advertiser, for example. And advertising is actually something that these companies are only starting to experiment with, and we think there's a long way to go. So it's early days. Cable remains profitable, and of course, the transition from linear to cable, unfortunately, will be bumpy. With hindsight, we probably bought into these shares a little bit early. We often do, but we think in time these will be better businesses. We also think they may very well be more profitable than they were in the past. And I can give you some numbers. But before I do that, maybe just to mention that an average US household subscribes to four streaming services on average each. And we think it's very likely that Paramount and Warner Brothers Discovery will be amongst the winners. They've created some of the most iconic content, both TV shows, movies around the world. Their studios are more than 100 years old. So we think they will be around, they'll survive, and in fact, they'll be one of the winners. On the numbers, Warner Brothers has a $27 billion market cap. On management's most recent guidance, they're guiding to just over $5 billion of free cash flow for this year, which puts the business on 5.5 times free cash flow, which we think is very cheap, particularly given that this is still a transition year. This is, we think normal earnings are higher. Paramount is a few quarters behind Warner Brothers Discovery in terms of its own monetization. But on our numbers, based on normal cash flows, the numbers are very similar to those of Warner Brothers. To give you some feel of the sensitivity, on average, a user is only paying around $4 a month across all of Paramount's users. If you add $2 a month to that subscription price, it adds $1.5 billion to pre-tax profits. Now, bear in mind that Paramount's market cap is only around $8.5 billion. So you can see that things don't really have to move much for these companies to be very, very profitable. You would have noted, I'll move on from that, just touching on, those that have followed us a little bit more closely over the past few quarters have noticed that Tesla, Amazon, Meta, so 3 large cap stocks, have crept into our top 10 and up our top 10 over recent months. Now, I often read articles comparing today's tech valuations to those in 1999. I think that this sort of doomsday content makes for good media, but I actually think the analysis is often a little bit lazy and maybe misguided. Now, ChatGPT was launched in November of 2022. Of course, we took a very close look at it. Our conclusion was that this could be transformative for businesses. If you want to find a historical precedent, and I caution that you need to do so with a lot of humility, because things are always different. We actually think there are quite strong parallels between today and the early 90s. The World Wide Web was released to the public in April of 1993. And I'll just give you one reminder, a company called Intel, which was the preeminent semiconductor company at the time, grew its revenue 6-fold, grew its profits 10-fold, and its share price went up 25-fold between 1993 and 2000. In fact, even today, Intel's share price is 11 times higher than it was in 1993, despite the bubble that we had in 2000 and 2001. So to today, from 1993, Intel's actually outperformed the S&P 500. We think similar to the early 90s, you could actually find a period in which productivity growth rapidly accelerates through both cost efficiencies as well as new avenues and sources of revenue. And we think, importantly, it's quite likely that a new cycle of technology capital expenditure has started. And we think Tesla, Amazon, and Meta are likely to be 3 significant long-term winners of AI. For Tesla, I mean, I don't have the time to do it justice, unfortunately, but just read up on Tesla's full self-driving software, the most recent version 12, and their supercomputer, which they call Dojo. Tesla, to me at least, embodies out-the-box contrarian thinking, and the latest version of their full self-driving could be revolutionary. In a nutshell, what Tesla are doing is they've moved away from a rules-based approach to autonomous driving, in which you have to have thousands of programmers physically typing out, manually hundreds of millions of lines of code, to a neural network. A neural network works basically like a human brain, in that it trains itself to become better and better by looking at millions and millions of real-life video clips of humans driving, and by looking at how humans respond to complex situations. And over millions and millions of iterations, it learns what works and what doesn't. Now, Tesla cars have been fitted with cameras for many, many years. And of course, the more data you have, the smarter your system. When I last looked, I think Tesla's fleet logged over 400 million kilometers, and it's probably a lot more now. I mean, every day it grows by several million kilometers. Tesla, excuse the pun, is literally streets ahead of its competition on this. And the system keeps improving. But by the way, you can also see how this type of learning requires loads and loads of processing power, which necessitates that AI CapEx cycle that I spoke to a little bit earlier. We think the autonomous driving part of Tesla alone could be worth more than the car company, depending on how it's monetized. And I haven't even mentioned the car company, which grew its production, for example, 13-fold between 2017 and 2022, and is likely to grow its production by a further 40 or 50% this year. In fact, an interesting anecdote, the Tesla Model Y is now the fastest selling car in the world of all car manufacturers, all models across internal combustion and electric. So we think Tesla is very interesting. I think the other company that we think are likely to be big beneficiaries of AI would be like an Amazon. Amazon is another example of a highly disruptive and innovative company that's not afraid of change. It's got the dominant share of US e-commerce. It's got a leading cloud computing business in Amazon Web Services, leading pretty much the biggest in the world by, at the moment, still quite a long way. And customers are continuing to migrate their IT across to the cloud, which is more cost effective. It's more flexible, it's easy to scale up, it's easy to scale down, and in many cases, it's also safer. And this segment continues to grow in the double digits. Now, I guess, is it sustainable? Well, we think it is, given that 90% of IT spend still happens on premise. And in fact, one of the big changes for us more recently is how AI and what that will mean for Amazon's cloud business. I spoke a little bit earlier about Amazon's AI processing demands. There are not many companies that can afford the supercomputers to do that amount of computation in-house. However, Amazon's cloud service business provides not only the processing capacity, but they're now also providing the toolkits and the foundational models to anyone wanting to utilize AI in their own businesses. So we think that strengthens their moat by quite a lot and should result in further growth going forward. In addition, Amazon's using AI to drive efficiencies in its own business, and the progress seems very promising, both in terms of user experience and also in terms of their own route to market, working capital management, etc. Meta is another great example of a company that has adopted AI very early to deliver more relevant content to its users, but also to provide better services to, for example, its advertisers, in the sense that they now have predictive models that will tell you how well an advert will do before you've paid for it, i.e. better monetization. They've also got a much greater focus on reducing costs and efficiencies going forward. And you're getting one of the best businesses in the world at probably a mid-teens multiple on free cash flow, which we think is attractive. And for Baidu, Baidu is just sort of the Chinese version of basically a combination of Google. They've got the search business, of course, but then they're also a leader in AI. They've also got a big cloud computing business, and they're doing some very interesting things around autonomous driving in China. And again, you're picking it up at a very reasonable multiple to normal earnings. And then maybe the final bit that I'll mention on the top 10, the last pocket of concentration, is our offshore drillers. Those are companies that own oil rigs, which they lease to the oil producers. This is a much more classic value play. It's a case of a lack of supply. You've had an underinvestment in drill ships for many, many years, which became even more acute during COVID, whilst at the same time now demand for their services are actually growing, and current day rates are rising very sharply from admittedly very depressed levels, but they're still well below where they were as far back as 2014. And they are very far below where they are in order to where they should be to incentivize the building of or the additional supply of drill ships. In fact, I think prices would probably have to, day rates would probably have to double from here before anyone would consider going back to a shipyard and placing an order for a $1.2 billion deep water drill rig. Meanwhile, most of these companies have very strong balance sheets and are producing a lot of free cash flow at spot day rates, and are trading on extremely low multiples of their normal earnings. So we think these companies are attractive. So just I'll conclude on the next slide. I mean, I'm hoping that you can see that we are equally comfortable holding fast-growing disruptors and innovators as we are owning beaten down cheap stocks. I think that flexibility and open-mindedness hopefully is part of what makes us different. At the end of the day, I guess the proof will be in the pudding. So here we show our long-term returns net of fees versus the world index and versus the average manager, and you can see over a long period of time we have beaten both of those benchmarks. We continue to be very enthusiastic about our shares, and we look forward to building our track record further. We also have an incredibly exciting pipeline of new ideas and opportunities and new stocks coming to the fund, so we're still finding lots of value out there. So we look to the future with a lot of optimism. And that's it.
Simon, thank you very much for that. Definitely a couple of shares in there that looks very, very interesting. Like Tesla, for argument's sake, I didn't realize that the future looks so bright as you describe it. Elon would be proud. Simon, thank you so much. We unfortunately much I'm not going to take any questions. You are all very familiar with Simon and the Contrarius Global Equity Feeder Funds available on all the platforms. Simon, again, thank you. We'll chat to you in the very near future.
Thank you very much, Eugene.
To our session today.
Thank you very much. Cheers. It was great to chat to you. Bye-bye. Bye-bye.
Just a quick last comment. We will be sharing the webcast of Alpine Macro with all of you. Unfortunately, we lost Shen this morning, but we'll get that content through to you. Sincere apologies for running a little bit over time, but we hope you found good value out of all our presenters. And to our presenters, thank you for doing a terrific job in putting together good content today and managing our clients' money. To the BCI team, Olga and Tanya, thank you so much for these sessions. And to our audience, you out there, not the least, definitely the most in our lives, thank you for your continued contributions. We are in Durban, the live show tomorrow, so I'm looking forward to seeing some of you there tomorrow, and we are in Cape Town next week. Until I see you again, keep well and be safe.